Okay, so we are also live on YouTube. In case you face any problem connecting to the audio during the webinar, you can kindly tune us with the live streaming of this webinar at YouTube. I'm sharing the link in the comment section. We'll be starting the webinar in another couple of minutes. Thank you for your patience. So very good evening, all the participants. So today is 1st of July. Today is CA day. Today is GST day. 3 years ago from today, the government introduced a new tax structure, that was GST. So we have a special webinar. We are organizing a special webinar to celebrate the occasion of 3rd anniversary of GST. We'll starting the webinar in another couple of minutes. Stay tuned in. Okay, so it's 4 p.m. Let's start just at the right time. So hello and welcome. I'm Shubham, and on behalf of Webtel and CGPI Nordzone, I would like to welcome you all to this webinar on landmark jurisdiction under GST. Before we begin with the webinar, I would like to cover a few points, a few meeting rules that all the participants should keep in mind during this webinar. One of the most important thing is to kindly turn off your videos for a better bandwidth. You can ask your queries in a very crisp manner, refraining to the subject of the topic. You can ask the queries in the chat section. If you are attending this webinar through Zoom, you can ask it through the chat section. And if you're streaming live through YouTube, you can ask it at the live chat section. The questions are being placed on real-time basis to the moderator. The moderator would attend the questions which serve the larger interest of the participation. And we'll be answering all the questions at the end of the session. So kindly stay tuned in during the webinar. So now I would like to introduce the moderators of the webinar. CA Rajeev Khandelwal ji, who's the director of Webtel Electrosoft Private Limited. Along with him, we have CA Pitam Goel ji, who's partner at Tattvam Advisors. Over to Rajeev sir and Pitam ji.
So very good evening, participants. Wish you a very happy CA day. I welcome you all on behalf of North Zone of Confederation of GST Professionals and Industries in India. I also welcome our learned speakers for today, Mr. Bimal Jain ji, who is a CA by profession, Mr. Sudipta Bhattacharjee ji, he is an advocate by profession, Mr. Tushar Aggarwal is a chartered accountant by profession, Mr. Kapil Sharma, again an advocate, and Mr. Ishaan Patkar, again an advocate from Bombay. CGPI is a national level alliance consisting of in-service and practicing lawyers, CAs, CS, and CMAs, focused primarily into GST divisions. CGPI main objective is to organize the indirect tax community into one common body so that a unified body can stand up for the interest of professional community as well as trade and industries with respect to GST. Through CGPI, we aim to create a platform of knowledgeable GST professionals of each state, city, and local area, and to bring all these leaders of the community under one common platform. I sincerely appeal to the participants who are not the members of CGPI to become members of CGPI, as there are certain benefits which are attached with membership only. Firstly, members get a right to participate in the intensive study sessions which are held on weekends. Objective of these intensive study sessions is to decode the GST law clause by clause. Recording of these intensive study sessions shall be made available to the members. Members will be benefited with respect to the paper presentations which are written and which are presented by the experienced GST professionals on various interpretational issues. These papers would help members in understanding the topics discussed. There are webinars related to various hot topics in GST which are accessible only to the members of CGPI. Recording again of these webinars shall be made available to the members only. CGPI is providing a national level platform and has been aligning with the trade and industries associations to take up their issues and representations at the appropriate authority. Keeping in view the above mentioned benefits, which are exclusive to the members of CGPI, we highly recommend the participants here to take the membership of CGPI. I sincerely hope that today's session would be very informative and knowledgeable. Request Mr. Rajeev Khandelwal ji to introduce you about Webtel, please.
Very good evening to everybody. Webtel, as you are all aware, is a software company which is in various compliances. We are pioneers of TDS and XBRL softwares in the country, and also various other solutions and we have a team of professionals led by CAs, CS, and various legal and software professionals. Next slide. We have also partnered with the government for various initiatives, and we have a bouquet of products like Virtual Office, which are websites for CA firms, which a new offering, which is a mini ERP for CA firms, also various TDS, income tax softwares, or a combination thereof, which is Goldmine, and WebSign, which is for digital signing of documents, etc. So we have a bouquet of products, and our latest addition to that is a work at home solution, which we proudly call as WA. And in this pandemic situation, I think we all have faced problems in working properly, and because offices are not fully functional. And let us see this. Social distancing is a new norm in the unprecedented situation. Stay home, stay safe. While safety is a big concern, how long can we wait for the situation to become normal? How to keep working while taking necessary precautions is a challenge for everybody. We need a utility to let us work at home. What is WA or work at home? WA is Webtel's new utility which allows access from anywhere to Webtel, Talibusy, etc. other servers to virtual server in data center in India, available 24/7. And it also has an option through static IP in on-premise server. Now the question would be how WA works. Let us see. Get server access through WA. Softwares like Tally, Busy, Webtel, etc. installed on the server only. Only WA installed on employee PC, no need for other softwares. Employees can get anytime, anywhere access to softwares on server, and access to user as per need to use basis. WA work at home solution for everybody to help you work. And this is how you will work. There will be a central server either on your premises or on the cloud, and each one of you can access the system server through your own homes, and it will be as if you are working on a LAN environment. Such good speed with necessary hardware solutions and the Webtel solution. A small step by Webtel for safety and security of your clients and the staff. Now this QR code is there, which you can scan on your mobile phones if you want to know more about WA utility. And already many of our CA friends and advocate friends, other professionals have already started working from home, and on a very limited basis, they go to offices and they are able to work at home using WA utility. So you can use your mobile phones scanners to scan this QR code and know more about this WA utility. Over to you, Pitam.
Thank you, sir. As you all know that we have already completed 3 years of GST regime today. Let us go backwards and see what was actually the need for implementing GST. During pre-GST regime, there were diversity in taxes to be charged, which thereby has created lot of complexities and litigations. Foreign company coming into India and domestic companies both were facing lot of challenges in respect of compliance as well as law side of various acts, as there were overlapping provisions among these acts. With the implementation of GST, it was supposed to be a simple tax with an agenda of one tax, one nation. Shri Narendra Modi ji at the inaugural speech at the time of implementation of GST informed that due to transparency of GST, due to technology driven proven trials, gray areas are ending, and the GST has inherent strength of eliminating the possibility of ordinary businessman being harassed by the officers. But in reality, we are of an opinion that litigation shall be almost at the same level as that was during pre-GST regime. Reasons to substantiate the above statement can itself be seen given the fact that more than 750 notifications, 1,000 advance ruling, 500 plus Supreme Court and High Court judgments, 400 plus circulars have been issued. In addition, there has been continuous change in law, GST portal, issues multiple retrospective amendments to make GST even more challenging. There have been significant challenges from both law as well as implementation side. With this background, we commence our webinar to discuss the major jurisprudence and propositions laid down in last 3 years. Now, I would like to introduce Mr. Tushar Aggarwal, who is a partner at Tattvam Advisors. So, Tushar Aggarwal has more than 10 years of experience in indirect tax, and he has worked with more than 8 years with Lakshmikumaran and Sridharan attorneys. He was also deployed with GSTN network for the purpose of GST implementations and has worked closely with the government officials. He has worked extensively with the government of India for the purpose of designing in GST returns, audit formats, and other reciprocating formats like ITC04. He has handled multiple GST transitions and implementations projects, post-implementation reviews, transitional plannings, trainings, registrations, preparation of procedures and policies, and filing of returns, and helped business in optimizing their models. He has been an active member of various trade associations such as PhD, CREDI, etc. And he has been actively involved in taking up various issues, industry issues, with the government authorities and the GST policy wing. He has also made many research papers and articles in reputed national as well as international journals, and has been acknowledged by various research agencies for his extensive input in the GST regime. Now, it is our privilege to have you on our forum, Mr. Tushar Aggarwal. You may please start your presentation, please.
Thank you so much for your kind words. I wish happy CA Day and happy GST Day to all the participants. Coming straight away to the topic, in next 25 minutes, we will discuss the landmark jurisprudence and the propositions that has been developed under repeal and saving clause, input tax credit, reverse charge, and valuation. The first issue which have been faced by the taxpayers is whether after implementation of GST, can department come and raise a fresh show cause notice or an investigation? Can they start the new proceeding? We have witnessed multiple judgments on the very same topic. Friends, after implementation of GST, the erstwhile law, that is service tax law, excise law, was omitted and repealed. The impact of repeal is very wide. It means even if you have evaded the tax, the department cannot come and recover from you because they don't have the provisions, because the act has been repealed. It is then recourse is given to the saving clause. When we see the saving clause under GST, section 174(2) deals with saving clause, and it provides that the repeal of act will not affect any right, privilege, obligation, or liability accrued, acquired, or incurred under the previous act. Similarly, it says that any investigation, inquiry, verification which can be instituted, continued, or enforced. The real issue which the taxpayers were facing was whether department can continue only the existing litigation, or can they even issue a fresh show cause notice, can initiate a fresh verification or investigation. So we have two series of judgments. One category of judgment laid down the law that since the one section 174 uses the term instituted, it only covers the proceeding already initiated before the implementation of GST. So we have Gujarat High Court, Delhi High Court, Jharkhand High Court, all these kinds of judgment In the second category of judgment, the court has laid down that when we talk about 172C, it talks about rights and obligations will be intact. So rights not only of the even of the department. So reading 172C and E together, the courts have laid down that all the investigations, inquiries, not only which have been instituted, but even new inquiries and new investigations can be done. So clear cut, we have two series of judgments. One laying down that you cannot do a new investigation, cannot issue a fresh show cause notice. Another laying down that government has enough power to issue a fresh investigation, issue a fresh show cause notice. So it will be interesting to see how in future finally the Supreme Court laid down the proposition.
Sorry, Tusharji, to interrupt you. Can we have full screen because we are unable to read what's coming on the screen.
I've it's on presentation mode only.
Sir,
try to get it on viewing.
Now?
Yeah.
Yeah.
Now
slideshow, sir.
Slideshow.
Now?
No, sir. Sir, slideshow.
I've done the slideshow only. Let me again reshare the screen.
Yeah.
Is my screen visible now?
Yes, sir. Yes,
Screen
sir.
is visible.
In slides.
F5 or click
I've
on
done
slideshow.
I have clicked on slideshow only. Now?
Sir, I think you can continue. You can escape from this mode.
Right.
Can you escape? Yeah, you can run like this. This is
perfect.
Better.
Perfect.
Okay, go on.
So what we have discussed till now is that we have various judgment on the issue whether a new show cause notice has been can be raised by the department or not. Clear cut, we have two categories of judgments. However, when it comes to service tax audit, please remember in service tax we have witnessed a series of judgments wherein the courts have held that service tax cannot be undertaken by the department. It's ultra virus. So Rule 5A got struck down. We had an amendment. Then finally, Delhi High Court in mega caps held that amended Rule 5A is also ultra virus, and it has been stated by Supreme Court. So in my view, if you get a service tax notice, etc., audit, etc., notice, then you can approach High Court for a stay. But in my personal view, when we talk about issuance of a show cause notice or issuance of fresh investigation, etc., apart from service tax audit, the powers under saving clause under section 174 is wide enough for the government to carry out any such investigation. Now, the second issue which we faced in last 3 years is whether state government can amend their VAT Act post implementation of GST. The issue arose in the case of Kerala High Court and Gujarat High Court, Reliance Industries. The issue is simple. Under VAT Act, we had certain limitation periods for assessment, issuance of notice, etc. What state government did, they amended the VAT law to increase the limitation period. They amended the law. They said that I will increase the limitation period, say from 3 years to 6 years, 5 years, etc. The tax player approached the High Court. They contended that since the VAT Act has been repealed now by 101 constitutional amendment, the power to amend or power to frame law with regard to sale and purchase of goods have been taken away, and all these acts have been repealed by June 2017. How can they make the amendments? High Court agreed with the taxpayer and said that when all the VAT acts has been repealed in June 2017, and once the act is repealed, it means it nowhere exists. How can the state legislature introduce a fresh amendment? They don't have the legislative competence to actually amend the law. So it's a very important proposition which we should keep in mind, wherein the courts have held down that state legislature do not have the power to amend the VAT legislature when the same has been repealed in respect of those commodities which are not retained apart from petroleum, etc. Now coming to input tax credit, broader propositions and judgments. The first is with regard to the CGST credit of the other state. Say I am in Delhi and I am availing a services from, say, Karnataka state of accommodation services. They charge me CGST and SGST. We all are clear that SGST is a law which is state-wise law. So obviously SGST credit will not be available. But when we talk about CGST credit, Can I avail CGST credit in Delhi? CGST charged by the Karnataka hotel. Can I avail the credit in Delhi? If we strictly see the rules and the regulations under the GST law, section 16, 17, 18, you will not find any specific restriction under the act. CGST Act is a single act. You will not find any specific restriction that you cannot avail a CGST credit. Obviously, the intention of government is never to give you a CGST credit of the other state. And when this issue came before Rajasthan Appellate Authority, they held that CGST and SGST law are parallel and go hand in hand. When SGST credit is not available, then CGST credit should not be available. Furthermore, the government is of the view that even in respect of IGST, if somebody is supplying you an IGST invoice, and if the place of supply is different from the location of the receiver, say I'm in Delhi, there is a supplier in Gujarat charging IGST invoice on Delhi, that is me. But he writes place of supply as Maharashtra, still I will not get the credit. This is because of the reason of the advisory issued by the GSTN, which says that in GSTR 9, ITC related to those invoices where POS lies in state other than that of recipient have been excluded. So government is of the view that you will get the credit only and only if place of supply of that transactions falls in the recipient state. However, there is no such clear-cut provision in the law. Maybe that may be the intent. So it will be interesting to see how courts actually laid down proposition in this manner in the next few years. This issue will definitely go to High Court and Supreme Court, and it will be interesting to see. Friends, under GST, there is a specific condition that a recipient has to pay consideration to the supplier within 180 days. So if the consideration is not paid within 180 days, then the supplier has to, recipient has to reverse the credit along with interest. And the proviso specifically says that this condition will not apply in case of transactions between distinct person or related parties. That will be deemed that the consideration has been paid. On this issue, there was an interesting AR in the case of Sangvi Movers, Tamil Nadu AR. In this case, there was an appellant wherein the head office of the appellant has entered into a contract with the recipient units, that is distinct person, different registration of the same legal entity. So they had undertaken an MOU, and there was a consideration clause in the MOU that for these kinds of services, I will provide this much of consideration. When the issue came before AR held that since you have entered into a specific MOU between distinct person, that is between head office and branches, and for the services given by head office to the branches, as per the MOU, branches is liable to pay consideration, then until and unless they actually pay the consideration, credit will not be available and they will be hit by this condition. They also laid down that netting off is not a mode of payment. When this issue came before appellate advance ruling, they overruled the judgment of advance ruling and said that netting off is also a mode of consideration. No issue, you can pay consideration by way of netting off, but they were silent with regard to actual need for payment of consideration. In my view, to the extent the advance ruling laid down that in case of distinct person, you should actually pay consideration when there is an MOU specifying the consideration is incorrect. See, in case of supplies between different registrations, that is like cross charge, stock transfer, I'm talking about such kind of transaction. Even if you have mentioned in consideration amount in the MOU, does not mean that that is actually payable. You need to actually pay. There is no need to transfer the amount from say Rajasthan branch to the Delhi branch. These supplies in itself does not require consideration. These are not supply itself. It's only because of schedule they have been deemed to be supply. Hence, to my view, this advanced ruling is incorrect to the extent it says that there should be an actual payment of consideration. The next series of judgments which we have seen in last 3 years is judgments on section 17.5c and 17.5d, which says that works contract services or credit on goods and services used for construction of immovable property other than plant and machinery for own account will not be available. So three kinds of issues is something which we have witnessed. First, what do you mean by construction on own account? If I'm carrying out a construction for myself and then renting it, is it a construction on own account? Second set of disputes which we have witnessed is what do you mean by plant and machinery? If I'm constructing a building, if I'm installing an AC, HVAC, fire extinguisher, etc., does it mean that I'm ineligible to get credit, or these will qualify as plant and machinery and I'm eligible to take credit. Third series of judgments which we have seen is what you mean by immovable property, whether something is movable, something is immovable. The one of the landmark and famous judgment in the case of Odisha High Court, Safari Retreats. The Odisha High Court held that in this case, the taxpayers was constructing a shopping mall and they have rented this shopping mall on which they were paying GST. The issue was whether they are eligible to take the credit of the goods and services which they have procured for construction of mall. The Odisha High Court held that once the taxpayer is actually constructing a mall and immediately renting it out and earning rentals on which they are charging GST, and also the purpose of GST is to avoid the cascading effect, section 17(5)(d) has to be read down to allow the taxpayers to avail the credit. In a nutshell, Odisha High Court allowed the taxpayer to avail the credit on goods and services which they have procured and the property which is subsequently rented out on which they are paying GST. In my humble opinion, I have some reservation on this judgment. This is still pending in Supreme Court. Appeal has been filed. See, the Odisha High Court relied upon judgments like Eicher Motor, Daiichi, etc., wherein there was a different concept of vested right. We all know Senvet credit or ITC is a vested right, but there is a difference between vested right and statutory right. Vested right is something when you eligibly avail a credit and then government tries to take away that credit. However, in this case, when we read section 16 and 17 together, my eligibility in itself is questioned. So the way section 17 is drafted, it says if I'm using the property on own account, I will not be eligible to take credit. So on account means for my own use. When I'm renting it, I'm not further supplying the immovable property. I'm using it on my own account for renting purpose, for storage and warehousing purpose, etc. So in my humble opinion, placing reliance on this judgment will be a very risky proposition. But in any case, we have to wait and see how Supreme Court finally laid down the proposition. Now coming to the disputes related to plant and machinery, we had a Karnataka triple AR, wherein they held that indoor surveillance system, fire extinguishers, chilling HVAC system, air conditioner, and various kinds of DG sets, etc., which was installed in a building, credit will not be eligible. And the reason which they have given is that when these items are installed in the building, they form part of immovable property. They get annexed to immovable property. Hence, they qualify as immovable property and credit should not be available. In my humble opinion, when we talk about installation of HVAC system, lift, excavator, surveying system, DG set, etc., even they form part of immovable property, still it's a plant and machinery. The definition of plant and machinery is wide enough. So if I am actually availing these services as a separate supply, issuing a separate work order, it should qualify as a plant and machinery. So this plant and machinery concept, what will qualify as plant and machinery, whether storage tank is a plant and machinery, breakwater is a plant and machinery, big refining system, they are plant and machinery. These will be the interesting issues which we will face in future. To conclude, when we talk about construction of a building, we have something called a civil structure. Second is plant and machinery called, say, air conditioner, excavators, etc. Third is my movable items, say furniture, tables, etc. So long as I am able to substantiate that I am separately availing the supplies of plant and machinery and movable properties, I should get the credit. In ITC, there is a specific section 17(5)(g), which states that credit of goods and services on account of personal consumption will not be available. Now, we had certain ARs which had said that when you're giving, say, a rent-free accommodation to an managing director, or they are staying in a hotel, etc., since it's for their personal consumption of the employees, credit should not be available. So what do you exactly mean by personal consumption in this section 17(5)(g)? In my opinion, it has to be read qua the taxpayer. So there can be two kinds of taxpayer, an individual or a company. When I say I am an individual, I am a taxpayer, I am using, say, a laptop or certain goods for my official work also, for my personal work also. Fine enough, credit will not be available. When we talk from a company's perspective, so whatever expenditure they incur on the employees, say staying in hotels, their flight tickets, etc., is it really a personal consumption by the company? It's a business expenditure which is being incurred by the company for its employees. The employees are working for the company. And to my mind, this condition of personal consumption has to be read qua the recipient of service, that is the company, and it should not be applicable. So these judgments needs reconsideration. The next set of disputes which we have seen in last 3 years is with regard to eligibility on various kinds of marketing schemes. Section 17.5 specifically says ITC in respect of goods lost, stolen, written off, destroyed, or given by way of disposed by way of gifts or samples shall not be available. So we had few ARs like Sanofi, India, Maharashtra, and then Surfa Court, wherein it was held that where the goods which are distributed under various schemes, the credit of the same will not be available. In Sanofi India, they had come out with a marketing scheme wherein the dealers were given reward points on purchase of certain quantity of goods and later which could have been awarded. The advance ruling held that since contractually it's only a general scheme and contractually you're not obliged to pay them, not obliged to reward them, it is not where coming out of any contract, the credit on goods and services given as a part of marketing scheme to dealers will not be available. Similarly, the Karnataka AR held that the goods and services which you give as a part of various schemes and free will not be available. In my humble opinion, when we see section 17.5, please again read it. It says ITC in respect of goods lost, stolen or disposed of by way of gifts, etc. So there can be three categories. First, I'm actually giving certain goods free of cost, say gold coin free of cost on the value occasion, etc. No issues, credit is not available. When we talk about free services, say air travel service, I give them free Indigo vouchers, etc., some service vouchers, etc. Since this is an expenditure which is incurred in the course of business and it is not specifically covered under 17H, 5H. So credit should be allowed. So the restriction under 17.5H is qua the goods and not services. Even though Karnataka AR held that free services, credit on free services is not available, to my mind, that judgment is ruling is incorrect. The third point which we need to keep in mind is our contractual arrangements for providing the schemes. So if I contractually provide for an arrangement of giving, say, on purchase of certain quantity of goods, I am liable to give them X product free, Y product free, and there is a contractual arrangement which is entered with the customer, then in these situations, we can say that I'm not giving anything free. Effectively, what I am getting the consideration is for all the products which I'm giving to them. And hence, credit should be available. But we should keep in mind two important points. First is that in this, we have to keep two important points. The first important point which we need to keep in mind is that there can be a risk of composite supply or mixed supply. So if you are giving two unrelated products, say one at 12%, another at 18% together for a single consideration, then you may run into a risk of mixed supply, charging the entire consideration at higher rate. Second is that there should be a proper contractual arrangement agreed in writing. Then only you will get the benefit. Otherwise, the way advanced rulings are being delivered on all these issues, most of the cases you face difficulty in taking the credit. Now, coming to our third issue, reverse charge mechanism. One of the most landmark and interesting judgment has been in the case of Mohit Mineral. See, in case of import of goods on CIF basis, I import the goods on CIF basis. It is the foreign shipping line who provides the transportation services to the foreign supplier. So the actual contract of transportation of goods from the foreign location to Indian location is between the foreign shipping line and the foreign supplier. I, as an importer, I import on CIF basis. Section 5.3 of the GST Act provides and empowers the government to enable this and empowers the government to enable recipient to pay under reverse charge in certain cases. So section 5.3 gives power to the government so as to make recipient of service liable to pay reverse charge instead of the supplier of services. Now, in case of import on CIF basis, it is the foreign shipping line who is providing the services to the foreign supplier. Who is the service provider? The foreign shipping line. Who is the service receiver? The foreign company who is exporting the goods. I'm only the importer of goods. So am I a recipient? So there is a vacuum in law under GST, under notification 8 by 2017 and 10 by 2017. They had come out with a deeming provision wherein they have deemed that importer will be liable to pay tax on such transportation services under reverse charge. So there was a vacuum in law which was realized by the Gujarat High Court, and Gujarat High Court categorically laid down that since I am not a recipient of service, since importer is not a recipient of service, and section 5(3) can be used to can be permit collection of tax under reverse charge only through recipient route. Hence, the levy is ultra virus. Not only this, they even went ahead and said that the services itself is not taxable in India, and that's a very major proposition laid down. They held that tax can be imposed only on an intrastate supply or interstate supply. No doubt it's not an intrastate supply. In GST, we have a residuary clause under IGST Act, section 75C, which says that supply of services in a taxable territory other than intrastate supply will be deemed to be interstate supply. So supply of services in a taxable territory. In this example, they held that when goods are supplied by a foreign ship, when the transportation services are supplied by a foreign shipping company to the foreign supplier, the service provider is outside, service receiver is outside, and just importer of goods in India, you cannot say that services is provided in India. It cannot be stretched to that level. So that's a very major proposition laid down under this judgment. And similarly, Calcutta High Court also followed the very same judgment. Another interesting dispute which we had witnessed is on the director remuneration. Whatever payments I am making to the directors, whether whole-time director, independent director, non-executive, executive, we have all categories of director. We had multiple advanced ruling, and then the clarification came through circular number 140. In a crux, what it actually held that if your director is working in the capacity of an employee and there is an employer and employee arrangement, then whatever payments you are making to those directors, they will not be considered for reverse charge purposes, and it will be covered under Schedule 3. So if you make a payment to an employee director, then these payments will not be covered under reverse charge. However, if you are making payment of, say, commission amount, sitting fees, etc., to a non-employee director, who may be an independent director, etc., reverse charge will be attracted. And whether a person is actually an employee director or a non-employee director has to be seen qua the contract with the director. You don't go by the designation. Even when we talk about whole-time director, the definition of whole-time director itself is an inclusive definition. So it includes a director who is in whole-time employment. So it may include another director also. So we have to be very careful with regard to the contract which I have entered in with the director. So if I'm making any payment to the director, rest be assured that no reverse charge is applicable so as long as they are acting in the capacity of employee, but you have to prove that they are acting in the capacity of employee through your contractual arrangement. Lastly, we will just discuss in another 5 minutes the landmark case on valuations. See, under GST, we know the unique concept of GST is the concept of supplies between distinct persons. They have made every registration of a single legal entity as a distinct person, and any supply of goods and services between these distinct persons is always taxable. Examples are stock transfer. Then we have example of providing support services of head office providing support services to branches. Then we have examples of giving of corporate guarantee by one related party to another related parties, multiple companies using the same common infrastructure. So we have various kinds of transactions which attracts GST as supplies between distinct persons or related parties. One of the most important issue arose with regard to the valuations between distinct parties and distinct and related parties. When we see the valuations, we have a concept of open market value, then we have a concept of value of supply of kind, goods and quality, then we have a concept of 110% of the cost of production, residual value, and we have two provisos. The issue which came before various advanced ruling was that there is a proviso under valuation rule, second proviso to rule 28, which says that if my recipient is getting full credit, then whatever amount I show on the invoice, that will be treated as open market value, and I should get the recipient, and that value should be the final value for the purpose of GST. The issue at advanced ruling level was some of the rulings held that you cannot directly go to the second proviso and you have to go sequentially. If open market value is available, opt for open market value. There is a first proviso which says that on stock transfer, you have to apply 90% of the value of the goods at which the goods are sold from the depot. So that 90% rule has to be applied. Later on at appellate level, all these rulings were overruled and it was held that we can directly go to provide second proviso to rule 28 and it's a welcome judgment, though we have seen that we should generally not rely much upon advanced rulings. They are generally adverse. But in the context of valuation between distinct persons, they have realized that we can directly go to the second proviso to Rule 28. And as per second proviso to Rule 28, where full credit is available to the recipient, then the value adopted on the invoice will be treated as open market value, and so is a welcome judgment. With this, I end my presentation. Thank you so much. Over to you, Pitamji.
Thank you, Tushar, for your insightful thoughts. Your experience says it all. Now, without wasting any time, let us introduce the second speaker for today, Mr. Sudipta Bhattacharjee. Mr. Bhattacharjee is a partner at Advaita Legal, a reputed law firm based out of Delhi, and he has more than 12 years of experience in providing strategic tax and allied commercial and legal advisory services to its clients, which are in various diverse sectors, and in structuring, drafting, reviewing, and negotiations of various contracts. He is a lawyer by qualification and has graduated from the prestigious National University of Judicial Sciences, Calcutta. Mr. Bhattacharjee specializes in all pre-GST Indian indirect tax laws, including customs, excise, service tax, as well as GST and contract documentation related services. He has been involved in providing strategic advice on GST transition and implementation in India to businesses across sector, and has undertaken several training sessions, has taken several training sessions educating clients and general public about the impact of GST on their key business processes. Mr. Bhattacharjee has written extensively on GST and other tax issues in newspapers like Business Standards, Economic Times, and tax portals like VAT Infoline, Tax Sutra. Mr. Bhattacharjee has been recognized by the International Tax Review, that is ITR, as one of the top indirect tax leaders for 2017 and 18 for India. It is our privilege to have him as a speaker on this webinar. Now over to you, Mr. Bhattacharjee, for taking this session forward.
Thank you. Thank you for the kind words. Am I audible?
Absolutely, sir. Yes, you're very much audible.
Great. If my slides could be shared, I'm having trouble sharing the slides here. Yeah, thank you.
Yeah, it is there, sir. It is
Yes,
there.
sir. It's on.
Let's go to the third slide, please. So, ladies and gentlemen, thank you for logging in. We are going to discuss in the next 25 minutes two topics. One is promissory estoppel, and second would be transit e-way bill related jurisprudence. So talking about promissory estoppel, the starting point has to be Article 39C of the Constitution, which talks about state's duty to ensure that there is no concentration of wealth. So basically, and from this flows the various schemes and incentives which try to incentivize industrialization in slightly backward areas also. It is in this context that when in 2003, Uttarakhand and Himachal Pradesh, a new industrial policy was introduced, which amongst other things thought about envisaged 100% central excise exemption. And pursuant to that, notifications were issued. Many companies have been taking the benefit of that. And it is in that context that we will examine the issue of promissory estoppel. Now, what is doctrine of promissory estoppel? There have been many landmark cases, Motilal Padampat, Indo-Afghan trading in 70s and 80s. We'll talk about, and we have accepted a judgment from 1995 of the Supreme Court, which basically says that if a party has made a promise and another party has acted on it, has altered his position, then the promisor cannot go back on that promise, except where the equity in the public interest so demands. Except where the equity in the public interest so demands. I repeat with emphasis, because this is where the entire set of litigation on promissory estoppel emanates from. That whenever a government, state or central walks back on a particular promise, the analysis has to be whether public interest and equity does it so demand. Next slide, please. So we spoke about the 2003 policy. That effectively got rescinded after GST came in, and because the rescinding of that notification led to a lot of heartburn among industry, a lot of losses, GST Council suggested, and sometime in October 2017, a budgetary scheme was announced by the central government. One of the key features, next slide please, one of the key features of the budgetary support scheme is the fact that the benefit was restricted to 58% of CGST and 29% of IGST that was paid in cash. Shubham, go to the next slide, please. So instead of a full excise exemption, the benefit was restricted to, as I said, 58% of CGST, 29% of IGST. Clearly, it's a fairly large, significant scale down for anyone who was availing a complete central excise exemption, and accordingly, many players challenged it. One of them reached the Delhi High Court, which is Hero MotoCorp, and we'll discuss the case of Hero MotoCorp, what happened in there. Next slide, please. So in the case of Hero MotoCorp, the rescission of 50 notification 50 by 2003, which prescribed for exemption to eligible units in Uttarakhand, central excise exemption, that was rescinded, as I said, with effect from July 1, 2017, and that was challenged by Hero on the grounds of violation of promissory estoppel. Unfortunately, the government, the Delhi High Court overruled, rebutted that particular argument of doctrine of promissory estoppel. They did not accept, and the various key points that they laid down are as under. Firstly, they laid a lot of emphasis on the fact that GST, in the post GST, the whole indirect tax regime has changed, it has been overhauled, so very minimal exemptions are now considered. They also placed a lot of emphasis on section 174(2)(c) of the CGST Act. 174(2)(c) is part of the repeal and saving provisions of the GST law. So which basically says, the C starts with saying that the repeal shall not affect any right, privilege, obligation, etc. Creates an exception provided that any tax exemption granted as an incentive against investment shall not continue as a privilege. So a specific exception has been carved out for discontinuance of a investment-linked incentive. And this was something that was heavily relied upon, emphasized upon by the Delhi High Court to rebut or overrule the argument of promissory estoppel. Next slide, please. Other points, and basis 174(2)(c), it was held that the rescinding notification number 21 was in accordance with that statutory framework under 174(2)(c). And it was also highlighted that the industrial policy has undergone a lot of change. It was highlighted that GST is, effectively a merger of various pre-GST taxes, and hence inter se credit between various taxes that used to be an issue earlier, that is no longer an issue, because under GST there is somewhat a seamless flow of credit across various levels. And it was highlighted that the promises in return for investing in Uttarakhand was a privilege and not in the nature of right. We'll come back to this point. This is a very, very critical point on which the case turned. Basis all of this, relying upon and emphasizing the fact that the constitutional validity of 174(2)(c) has not been challenged, the Delhi High Court concluded that there is no case of invocation of doctrine of promissory estoppel. So key takeaway from this judgment is, if any of us are suffering or want to invoke promissory estoppel, we have to, in order to distinguish, in order to get Hero MotoCorp judgment out of our way, we have to challenge the virus of section 174(2)(c) if we wish to. If we want to have any chance of success. Now, let's go to the next slide, and we will deal in greater detail on the point of right versus privilege. If you see, 174(2)(c) is excerpted in entirety. And as we saw in the first slide, this uses words like right, privilege, obligation, or liability. And then comes the proviso, which, although only talks about privilege. So it's a settled rule of statutory interpretation that when different words are used, different meanings are intended. So if right, privilege, liability, obligation, separate words are used, they all have separate meanings in law. But the proviso is only being carved out for privilege. It is saying that a tax exemption, which is investment linked incentive, is a privilege, and I mean basically will not qualify as a privilege for the purposes of the foregoing section. Proviso, as we know, is an exception to the main rule. So when the main rule talks about right, privilege, obligation, liability, exception is only carved out for privilege, not for the others. So this is an important statutory point to remember. However, Delhi High Court did not get into these niceties. Delhi High Court straight away said that the exemptions granted were in the nature of privilege, and hence, as per 174(2)(c), there is no case for promissory estoppel. It is my humble opinion, with the greatest of respect to the Honorable Delhi High Court, that this probably was a conclusion in error. Let's move to the next slide. The reason I say this is a conclusion in error is the distinction between right and privilege is well recognized. When a taxpayer fulfills the conditions for claiming an exemption, then that exemption becomes a right. It is no longer a privilege. Availability of an exemption upon fulfillment of some conditions, that is a privilege, that is a concession. Once I have fulfilled the condition, I have acted based on that promise of a concession, it becomes a vested right. And this is not my interpretation. This is an interpretation that has also been blessed by the Supreme Court in the case of Kanak Exports earlier. So the Delhi High Court, to the extent that it failed to make a distinction between right and privilege, I think it is humbly submitted, is in error. Second point is, section 174(2)(c) is not a prohibition on exemptions. It is, as we saw, a very simple thing. It says that this particular thing will not constitute a privilege. It does not talk about being a right. It does not talk about being an obligation. Only for privilege, exception has been cast. So 174(2)(c) cannot be read as a prohibition on grant of exemptions. CGST Act in section 11 clearly empowers the government to notify exempt supplies. So to that end, where Delhi High Court emphasized on the fact that the design of GST is antithetical to exemptions, I think that sort of a blanket statement was probably erroneous. So anyone who is planning to challenge the Delhi High Court judgment in appeal, or wants to launch their own challenge on a similar facts, will have to try to distinguish and bring out these points when they mount their own challenge. However, if the attitude of the Supreme Court is anything to go by, I don't think there is much cause for optimism, because Supreme Court recently took a very narrow view vis-a-vis promissory estoppel in the case of VVF Limited, and we will deal with that. Let's go to the next slide. So VVF was not in the context of GST, but nonetheless, definitely worth discussing. This was in the context of, so there are 2 or 3 sets of appeals. It was a batch matter. The first batch, which became the leading batch of matters, pertained to central excise exemption that was granted in 2001 after the massive earthquake that rocked Gujarat. So for certain areas like Kutch, etc., which were backward, incentive was granted by way of an excise duty exemption. And there was a complete exemption. However, sometime in 2008, the exemption was amended, and instead of 100%, it was made to be a 34% exemption. So a massive scale down. And it was this notification, amending notification, that got challenged in Gujarat High Court by various parties, and the SSEs won before Gujarat High Court on the ground of promissory estoppel. The High Court accepted the conditions, and of course then the government went on appeal, the revenue went on appeal, and it is that appeal of the revenue which has succeeded before Supreme Court last month. So the Supreme Court basically said that notification 16 was in the nature of a clarification, which is frankly quite surprising. They said that it was to clarify the basic intent of the main notification. The objective of the main notification was to grant exemption only on the activity of value addition and not something else. And and accordingly, the doctrine of promissory estoppel cannot be invoked. The court also spent a lot of time discussing what is public interest and how public interest is a recognized exception to promissory estoppel. Let's go to the next slide. So as I said, they spent a lot of time and effort on discussing what is public interest. And here, undue emphasis, in my humble opinion, undue emphasis was placed on the fact that there have been a lot of fraudulent activities vis-a-vis these exemptions. The government kept arguing that since there have been widespread fraud, people have been misusing this benefit, people have been taking this benefit without conducting actual manufacture, so on and so forth. They were forced to introduced this condition in notification 16 to reduce the exemption from 100% effectively to 34%. And unfortunately, Supreme Court accepted this argument. They said that if fraud vitiates all, and if the idea is to stop fraud, then it is in supervening public interest. The Supreme Court also went on to say that notification 16 is not taking away any vested right. It is clarificatory in nature, like we discussed. And the objective was always to grant benefit to genuine players and not to fraudulent, fraudulent players. So that point is well taken. We can go to the next slide. So that point is well taken. It is well recognized in law that fraud vitiates everything. But to my mind, with the greatest respect, I must submit that Supreme Court probably was probably this was a disproportionate sort of a example, disproportionate sort of a conclusion. I mean, imagine this, probably a far-fetched analogy, but there is a lot of discussion about GST frauds, ITC input tax credit frauds under GST. If tomorrow government decides that we will only give 34% credit, I mean, that would be disproportionate, right? There are a lot of ways and means in the law to prevent abuse. So just because there is abuse, you cannot take away the benefit, curtail the benefit by 66%. To my mind, that is disproportionate. And to that extent, and to the extent that VVF case decided or depended heavily on the fact of on the fact that there was widespread fraud, it can be factually distinguished. So yes, I mean, as a conclusion, yes, VVF case definitely dilutes the strength of our argument based on promissory estoppel. Anything that we may take in future, but it is, all hope is not lost. This is not the last word on promissory estoppel. Factually, both VVF and Hero MotoCorp, as we saw, can be distinguished. And so any of us who are planning to mount any challenge on the basis of promissory estoppel ought to keep these two cases in mind. In the next slide, let's go to the next slide. In this slide, we will talk about one live case that might open up and lead to further litigation in terms of promissory estoppel. Some of you may be aware that Uttar Pradesh came up with an industrial investment policy in 2017, which granted SGST refund of SGST paid in cash to a certain extent, subject to certain proportions. Now, recently, state government has issued they are calling it a standard operating procedure. It came out on June 12th, which basically says that to the SGST reimbursement would be reduced to the extent of SGST IT credit that is available in the credit ledger. It also imposed certain other restrictions on interstate sale. So the question that arises is, how can something which is called a SOP go beyond the policy in terms of imposing a restriction that is beyond the rigor of the policy? And also, how can the benefit of that is granted in 2017 be taken away even without amending the policy through something like a SOP? So I think this will probably be reaching the Allahabad High Court in the next few months. So this will be a space to look out for, to see how the jurisprudence on promissory estoppel further shapes up. The next topic that we are going to touch upon is are the various disputes that have emerged in the context of e-way bill, or basically goods in transit. So the legal provisions that pertain to this issue are section 122, which makes it an offense for person transporting goods without valid documents. Section 130, which provides for powers of confiscation for the person who supplies or receives goods in contravention with an intent to evade. And section 129 is detention of goods in transit if there is a violation of provision of the act. Now, all of these are fairly wide-ranging powers, and there has been a lot of allegations of misuse. One of the all of us remember in 2017, one of the pillars of GST was free transport or free movement of goods. The state checkposts were to be abolished, and they have been abolished. But effectively speaking, the roving squads still create quite a menace. They still put a barrier to interstate free movement of goods. Recognizing this, a circular was issued in 2018 saying that minor discrepancies in things like in e-way bill, for that goods should not be detained. Minor discrepancies, the examples that were given were errors in address, error in 4 or 6 digit HSN, error in 1 or 2 digits of the vehicle number, spelling mistakes. These points were outlined. However, this has not helped much, and we can go to the next slide. This has not helped much, and we have had various cases, literally dozens of cases from high courts, from appellate authority under GST, on the issue of detention, on the issue of frivolous detention rather, and parties have had to knock the doors of the courts very often, unfortunately. Key learnings that emerge from some of these decisions I've tried to summarize without getting into each of the decisions. The first point is, in case there is a classification issue involved, and detention then has to be very limited for a very limited period, the state in which the detention happens cannot basically take action. They can only prepare papers and send a communication to the original assessing jurisdiction saying that we believe there is an issue in classification, please look into that. That is all, and that is the extent of detention that that anyone can do. So if goods are being sent from West Bengal to Delhi, and officer in Delhi stops the vehicle for detention under 129, and on the issue of classification, this is the limited power. He can detain it only for that 1 hour, 1.5 hours that it is required to make a documentation and send communication to the West Bengal authority saying that I believe there is some error in the classification, please look into that. Similar for valuation disputes also, detention cannot happen for valuation except for communicating to the assessing jurisdiction. Similarly, for if a driver of the vehicle has opted for a different route than usual, that cannot be a ground for detention. If a driver has taken a wrong turn, traveled beyond the destination by mistake, that cannot be a ground for detention. If there is even a typographical error, and this is a fairly extreme example, where instead of 2,000 kilometers, the e-way bill said 20 kilometers. It was clearly a typographical error. And even in that case, it was held that detention was invalid. And I touched upon section 130. So let's talk about, in the next slide, we will talk about Synergy Ferticum case of the Gujarat High Court. Let's go to the next slide. Synergy Ferticum, this is a landmark decision that has come vis-a-vis interpretation of section 129 and 130. They have laid down some 16 points which have been followed by several other high courts, as well as, of course, several other cases in the Gujarat High Court itself. The key points vis-a-vis 129 and 130 that they lay down are that 129 and 130 operate in different spheres. For invoking, so just because there is 129 invoked, you cannot automatically invoke confiscation powers under 130. The threshold for invoking confiscation powers under 130 is much higher. The authorities have to be prima facie satisfied that there is an intent to evade tax. Without satisfaction of intention to evade tax, section 130 cannot be invoked. And they have also clarified that sections 73 and 74 under GST, which deal with demand, recovery, show cause notice, etc., warranted for the purposes of interpreting 129, 130. So all these judgments that we saw, including Synergy Ferticum, clearly, while they are laudable, they have given relief to the assessees, they have not given the desired level of protection. They have not given the sufficient level of ease of business, ease of transit for assessees. So as an alternative and a more aggressive strategy, if any of our clients are facing issues in a particular location, in a particular jurisdiction, it may be a good idea to explore filing a writ challenging the very constitutional validity of section 129. There are strong grounds for that, and 3 writs have already been filed just before lockdown on this issue in Kerala, in Gujarat, in Bombay. And this can be a strategy worth looking at. Some of the key arguments are, of course, the fact that extraordinary powers have been given to the officers without much of a checks and balances. There is no distinction between major and minor violation in section 120. All unequals have been treated equally, which is a violation of Article 14. It effectively tantamounts to levy of GST on a transaction, though indirectly, even though something is not even a supply. And so to that extent, it is going beyond the constitutional power to levy GST, constitutional power under 246A. And of course, this is clearly a restriction on free movement of goods. So all of these grounds, to my mind, are strong grounds. So any of us, our clients, are suffering because of persistent issues in transit of goods, this is worth exploring. With that, I thank you and hand over the mantle to Bimal Ji. Bimal Ji, welcome.
Thank you, boss.
Welcome, Bimal Ji.
Thank you.
I'd like to introduce Bimal Ji, though he does not require any introduction. C. Bimal Jain is executive consultant at A to Z Tax Corp LLP and has around 25 years of experience. He's a qualified CA as well as CS. Further, he also holds a bachelor's degree in law. His core competencies indirect taxation, international taxation, and corporate taxation. He carries a blend of industrial and professional experience. His accolades include Business Leader Award from Amity School, Noida, Best Speaker Award by NIRC, and Young Achievers Award at Igniting Minds 2015. He's the mentor of Indirect Tax Committee of PhD Chamber of Commerce, Chairman of Corporate Advisory Committee of IPM Group of Institutions. He's also a member of IDT Committee of SOCHM and FICCI, and a member of GST and Service Tax Committee of ICAI and ICSI. He's an eminent faculty of ICI, ICW, and ICSI. He has also authored a number of books on indirect taxation. So right away, we'll give the mic to Bimal Ji. Welcome, sir.
Thank you. Thank you very much. Good evening to all the participants, and thanks to organizer inviting me for today on deliberation on supply, understanding and intricacies. At the outset, let me wish each one of you happy CA Day, happy GST Day, and happy Doctors Day. Now, the topic is supply. I was just a while ago on ICSI platform, and they are celebrating GST Day today. Sri Piyush Goel ji and Sri Sushil Modi ji was there. And even in panel discussion, I was having panel discussion with Prakash Kumar ji, CEO GSTN. I was asked one question, and this question I'm throwing away to all the participants. See, in GST, we all know that we got into GST with the big bang. It's the biggest indirect tax reform since independence. 17 indirect taxes merging into one basket with 23 cess. Lot of pre-GST compliances subsumed in GST. We know that cascading of taxes, tax on tax, credit was not available. That is also gone. Double taxation. A particular transaction was chargeable to service tax and VAT, both together gone in GST. A supply can either be supply of goods or supply of services in GST. And one nation, one tax from Kashmir to Kanyakumari. I normally say GST law is a Gita, Bible and Quran, irrespective of any language, religion, race and caste. This is what the GST background, but the topic which is given to me, I can tell you it is 100 years of practice now. 100 years of practice is my betting to all of you. See what happened. Central excise was applicable on term manufacture. Manufacture is being defined under section 2 subsection F of Central Excise Act 1944. But term manufacture is not settled as yet. Still we get debate, litigation in the Supreme Court whether activity undertaken is a manufacture or not. Now look at the term supply, which is a taxable event. If you look at chargeable section 9 subsection 1, or if you look at section 5 subsection 1 of IGST Act, chargeable section says GST applicable on supply of goods or services. So what is supply? That is important. And that is the topic which I'm going to discuss with all of you today. The way term supply is being defined in GST law under section 7. It says supply includes without saying what is supply. So term supply left open for individual interpretation, subjective definition, and they have not defined what is supply, subjective term. When this is subjective term, next question will come. This goes further, supply includes. So first subjective term, then includes, and then say it includes all forms of supply of goods or services or both. Now with this line, do you want anything else to be covered in this definition? But no, this definition goes further as if Bimal Jain has not understood the definition and says such as 8 exemplary terms are being included: sell, transfer, barter, exchange, licensing, leasing, renting, disposal. 8 exemplary terms, but let me clarify, none of the term is defined in GST law. Something which is included as exemplary terms and not defined in GST law, then giving third rider, first the subjective definition, second the inclusive definition, and in the DOIPEC, Apex Court judgment, Supreme Court said, whenever any term says includes, it makes its meanings wider. And 8 exemplary terms, none of the term is defined in GST law. Made or agreed to be made for a consideration. Consideration can be monetary and non-monetary. By a person, but there's no reference of to a person, meaning thereby even self-service can also be supplied in the course or furtherance of business. Fortunately, it is being stated in the course or furtherance of business. So what is the meaning of term business? So I'm just starting that this supply, which is taxable event in GST, I'm going to tell you this is 100 years of practice. Let me take one example and let's start with, and we can go down further. We can discuss number of other examples as well. Let's say a particular, I'm a mobile supplier. I'm supplying new mobile phone to the customer. Now, some customer coming to me and he is purchasing a new mobile worth 24,000 rupees. But he's exchanging with old mobile phone. So he's giving his old mobile phone to me and paying me 20,000 rupees, and I'm giving him new mobile which is worth 24,000. This transaction is what? Exchange, barter, and then the valuation. If I ask this question, valuation, I'm sure you will all say 24,000. In the hands of supplier who is supplying new mobile. What happened in the hands of customer who is giving me old phone worth 4,000 rupees? Is it in the course of furtherance of business? You need to really analyze all these problems. And whenever you look at this transaction from 9 subsection 4 perspective, which is not there as on date, but it's a big issue. But this is not in the course of furtherance of business in the hands of customer. He is only giving his consideration in cash and in kind. And that is how GST law need to be evolved from the term supply perspective. I said consideration can be monetary and non-monetary. Let me take one more example and discuss with all of you. Let's say you wanted one opinion from me. I gave the opinion to you. This opinion normally going to fetch me 50,000 rupees. 50. Had I given this opinion to any independent party, it would be 50,000 rupees. I'm creating 3 situations for you. And why 3 situations? For getting better understanding of GST so that you will get a clarity what I'm referring to. So what is the clarity I want to pass on? The first situation. As against 50,000, you're not giving me any consideration. You're not giving me any consideration. Or I'm giving this opinion without consideration. It is in the course of furtherance of my business, but no consideration charge. GST leviable? Answer is no. Unless there is consideration, it is not a supply, GST not leviable. Exception. Schedule 1. If we are related parties, then this is chargeable to GST even though without consideration. So entry 2, Schedule 1, supply of goods or services or both between related person or distinct person. In the course of furtherance of business, even without consideration, GST leviable. First part. Second part, you have no money to pay me. I have raised the invoice for 50,000 rupees. On accrual basis, I have deposited the GST to the government department, which as a customer you have not paid to me. And it becomes bad date, full bad date, complete bad date. What happened? Being customer, you have not paid me the value. You have not paid the GST to me. And on this amount, I have paid GST on accrual basis. What happened? Is there any relief which I can get as a supplier? You must have heard of credit note in GST. And credit note can be issued under section 34. There are 4 situations prescribed. If as a supplier, I've charged the higher taxable value as against the actual value. So as against 100, I have made 120. Or I have charged the higher taxes 20 as against 18. Or there is return of goods. There is no return of services. And last, when there is deficiency in goods and services, credit note can be issued. Now, this situation, where being supplier, I paid GST liability on accrual basis. You haven't paid to me, my customer haven't paid to me, and this is being deposited. Do I have any mechanism in GST to net off this GST which I paid from my own pocket? As per law, there is no mechanism for return of services. But there is one jugaad. Why I'm saying this term supply is going to be 100 years of practice, believe me, and I'm giving all subjectivity to you. And what is that jugaad I'm referring to? Which may be out of GST, but can help me as a supplier to adjust my GST which I have paid on accrual basis. What I will do, I will come back to you and request you, boss, you pay me 1% by check. 1% by check. I will repay you this 1% in cash. So whatever you pay me by check, I will return you in cash, and then I will design this particular transaction as a deficiency in services so that I can adjust GST which I paid on accrual basis. Coming to the third component of same transaction. Now you are a respected customer. You say, Bimal, money is not there with me. I can't give it to you. I've got one watch. And this watch worth is 20,000 rupees. 20,000 rupees. You take this watch. I will not be able to pay you 50,000 rupees. Now tell me, you have given me watch, which is in-kind consideration, worth 20,000 rupees. Is GST going to be leviable only on 20,000 or 50,000? Next question to all of you. We have to go back to transaction value. And transaction value means the valuation for chargeability of GST. It said it should be transaction value, price paid or payable. When buyer and seller, supplier and recipient are not related, and price is the sole consideration. Price is the sole consideration. If these 2 provisions are being satisfied, then GST leviable only on 20,000 rupees. If supplier and recipient are related and price is not the sole consideration, and looks like this price is not the sole consideration. Looks like this price is not the sole consideration, because this opinion would have fetched me 50,000 rupees as open market value or like kind of goods or services. I need to go back to GST valuation rule. And GST valuation rule says, rule 27, Bimal, if you are unrelated, but price is not the sole consideration, then GST going to be leviable on a value which consists of monetary consideration and monetary consideration of in-kind part. So need to be added back. So in this given example, when price is not the sole consideration, valuation becomes the issue. So term supply is not individual way to look at. You have to look at supply from holistic perspective. Then only you will come to know what is the term supply means. Now, having said supply, next question to all of you. You give me 50,000 rupees advance today for giving opinion at a future date. For giving opinion at a future date. You know, advance against supply of goods, no GST, effective from 15th November 2017, but advance against supply of service GST leviable. Even though supply is not made, it is in terms of time of supply provision under section 13, GST leviable. So what happened? GST discharge on advance money received by the supplier and a receipt voucher is being issued. Now, repercussion could be if service is rendered against this advance receipt, then you're going to raise the invoice and GST charge on that invoice can be adjusted with the GST paid on advance money. But if service is not being rendered, what you can do? Then there's a refund voucher concept. Am I right? Refund voucher concept for adjustment of GST. So GST not only banking on supply, it is banking on so many other provision. And you have to really check all other provision for the chargeability. So this was the example I given to you. Let me go next step further. I said there is schedule 1 for specific entry, even though no consideration, GST leviable. The first entry says permanent transfer of business asset where ITC credit has been taken. ITC credit has been taken. So I'm a company and I'm giving my laptop, 50 laptop, which is used for 3 years to some NGO, and without consideration, whether GST leviable. If I look at this entry 1, permanent transfer of business asset where ITC credit was taken, even though without consideration, GST leviable. If I change the example, let's say I purchase motor vehicle, I'm a company, for transportation of my employees, CFO and CEO. Now I'm giving this car to some NGO without consideration. Whether GST leviable, GST not leviable. For simple reason, ITC credit was not taken. But if some consideration charged for this motor vehicle sold, then GST leviable, and this motor vehicle not your business, but still it will be considered in the course of furtherance of business. I'm just highlighting and making things more interesting for you. Schedule 1, entry 1. Entry 2, schedule 1, very much interested, and it is debated as on date for cross charge versus ISD. So you know that if I'm a head office and I'm having a 4 plant, and let's say I'm having 4 plant in same state, in pre-GST for 4 plant, I need to have 4 separate central excise registration, even though they were in one state, in same state. In GST regime, this was done away with. They say now you can take 1 registration within the state for your multiple unit, unless you look for separate registration from business vertical wise, and this business vertical provision got changed to different place of business from 1st of February 2019. So it is at my option. I can take separate registration or within 1 registration. If I'm taking 1 registration and stock transferring from A unit to B under 1 registration, no GST, then they are not distinct person. If we have taken separate registration, then we become distinct person, and then stock transfer made from A unit to B unit, GST leviable. Had there been 4 units in 4 different states, then there is no concept of one registration. In pre-GST, 4 central excise registration. In GST, again, 4 separate registration. And being separate under same PAN number, they become distinct person. Hence, stock transfer of goods between distinct person, GST leviable. Only point comes valuation. On what value GST going to be leviable? Rule 28 says that valuation can be either open market value, like kind and quality, or you can pick up that proviso which talks about that supplier can pick up 90% of selling price of recipient unit at which he's selling the goods to unrelated person, same goods. So 90%. If recipient unit is selling at 100 rupees, supplier can take valuation at 90 rupees. And there's another proviso which says that if recipient unit is eligible to ITC, input tax credit, whatever value declared by supplier would be considered as a deemed open market value. So this 2 proviso you can interplay and check how these can be applied. Now, but for services, this cross charge is hue and cry as on date in the industry. What is this cross charge? Let's listen carefully. I'm a service sector, and from service sector perspective, this is becoming very critical. I'm having head office in Bengaluru, and I got 6 branches in different states. In my head office, my CEO, CFO, my common HR team, IT team, accounts team is sitting. With any stretch of imagination, can you say that head office is giving, supplying any services to branches? And this matter was raised in one of the advanced ruling, Columbia Hospital, which is upheld by appellate authority also. And if you look at the provision of entry 2, schedule 1, there is supply of service between distinct persons. Even though no consideration, GST leviable. Next question will come, what is the valuation? On what value GST going to be levied? Then you can always use this proviso, second proviso of Rule 28. If recipient is eligible to avail ITC, then supplier can even pick up ₹1 for cross charge to the recipient unit. Possible, and that ₹1 would be considered deemed open market value. Problem will come only when recipient is not eligible for ITC. Maybe they are engaged in exempted services, healthcare, education, exempted. Then what happened? Can I pick up this ₹1? Answer is no, not possible. Because recipient in that case is not eligible for ITC, burning issue. But now what is the valuation then? So valuation we have to look at head office, total cost. So total cost may be divided into 2 components. One is the salary component of CEO, CFO, common HR team, IT team, and accounts team, and other costs is overhead cost, total overhead cost. With the salary cost need to be included in total cost for raising cross-charge invoice to distinct person. We are having divergent perspective from different tax consultant. Somebody will say, without including salary cost, it is not a total cost. And somebody will say, why I am going to include salary cost? Salary, which is neither a supply of goods nor supply of services, in terms of entry 1 schedule 3, why I'm going to include it? Is it not taxing something which is directly not taxable? And in case of exempted sector, healthcare and education, if I include salary cost, it will add cascading. It will add cascading. And 3 years gone in GST, we are enjoying GST day to day, celebrating GST day today. Government has not come forward to explain what would be the valuation method in case we are talking about exempted sector. And therein, this dispute lies even as on date, Coming to the next part, within this supply definition, there is schedule 2. And schedule 2 only meant for classification. Classification, either a transaction is a supply of goods or supply of services, but cannot be both. This double taxation, which was there in pre-GST, is being done away in GST regime. It can be either supply of goods or supply of services. Now this schedule 2, which was there under section 7, subsection 1, clause D, is being done away with, retrospectively amended. And what is retrospective amendment? Schedule 2 now only going to determine classification, whether a transaction is a supply of goods or supply of services. But it is not a supply till the time it is satisfying 4 corners under section 7, subsection 1. So what is the conclusion coming out? The schedule 2 only going to be used for determining classification. It is supply only when it is satisfying 4 corners of provision under section 7, subsection 1. Then only it is supply, otherwise not. Having said all this part, next thing comes out from schedule 2, liquidated damage. Liquidated damage, whether per se chargeable to GST. I'm of the considered opinion that liquidated damage per se is not chargeable to GST. Non-compete fees, which is one of the transaction, money consideration for non-acting, and liquidated damage are 2 different things altogether. Any contract, see, whenever liquidated damage are being given, it is being given to compensate the opportunity loss or loss incurred on that account. This liquidated damage are being given. Do we have entered in a contract to make mistake, contravene the law and contravene the contract and pay the amount? No, we never intended to. We never get into such kind of contract. We normally go into the contract for supply of goods or services. These penalty clause entered into the contract only for creating compensation, where loss can be compensated. This was not the intention for the supply. And to my mind, liquidated damage per se cannot be really chargeable to GST. So it is falling in para 5E of schedule 2 as a supply of service, but not supply. And we can always debate on different factual position that GST not leviable. Coming to schedule 3. Schedule 3 having 8 specific entry. That is neither a supply of goods nor supply of services. Recently, the Gujarat advance ruling coming in, and in that ruling, what is being decided that I'm registered in India. I got some customer in US, and he wanted a supply of particular goods. So instead of sending goods from India to US, I have identified customer in Korea, South Korea. I will not identify now China. I will identify my vendor in some other countries than China. So I got vendor in South Korea who the supplier has supplied goods directly from Korea to US. Korea to US. Now in this transaction, I would be having purchase inward supply, bill to. So Korea vendor going to bill to Bimal Jain in India, and then Bimal Jain going to invoice, sell invoice to US customer. In that advance ruling, it was asked that on purchase, which is my inward supply, invoice raised by vendor from Korea to India, whether GST leviable. Fortunately, advance ruling has given good judgment saying that no GST, because till the time goods entered into custom frontier of India, no GST. So no custom duty, including IGST, fortunate part. But what happened for my outward supply? Sell invoice from India to US. Money is coming also to India. With the GST leviable, advanced ruling authority has said this is a kind of transaction in the import-export scenario, and hence interstate supply, IGST leviable. And this judgment is the recent judgment, and para 7, para 8. 3 transaction: merchant trading in third country, high sea sale, and inbound sale when goods are being stored in a custom bonded warehouse. Para 7 and para 8 entered, included in Schedule 3, effective from 1st of February 2019. This provision was existing when this ruling was passed. To my considered view and my humble opinion, this is not chargeable to GST, not chargeable. Even though, had it not been entered, had this para 7 and para 8 is not entered into Schedule 3, even though this transaction is not chargeable to GST. Can you charge GST which is affected in a non-taxable territory? Then you're just making aggression, getting beyond your power, taxing something which you can't tax, to my mind. And next, when we talk about that this merchant trading in third country, high sea sale, inbound sale, let me tell you what is high sea sale. Let's say I've imported something at $100. When my goods on high seas not entered custom frontier of India, I sold the product to you at $120. You are the person who is going to file bill of entry for home consumption. So what happened in my hands? I have purchase of $100, sell at $120, whether chargeable to GST? No. And what is inbound sell? I imported at $100, stored my goods in custom bonded warehouse by filing inbound bill of entry. And when my goods are stored, I'm selling to you at $120. And you are the person who is going to file export bill of entry, then you will pay custom duty, including IGST. In my hand, not chargeable. So these transaction para 7 and para 8 entered into Schedule 3 transaction from 1st February 2019. To my mind, even though it got inserted from 1st February 2019, but it is only, can be said, it is with retrospective date, 1st July 2017. And why so? Because when some transaction which is being clarificatory in nature will always have retrospective date of implementation. That is what my argument, and we got subtle legal jurisprudence that any tax, any change in taxation law which is clarificatory, benefiting to the taxpayer, should always be read from retrospective date. And to my mind, even though inserted from 1st February 2019, but applicable from 1st July 2017. I differ with that particular advanced ruling of Gujarat. Having said this thing, that para 7 and 8 of Schedule 3, when my outward is not taxable, next question will come, what happened for the ITC, GST input tax credit? My outward is not taxable. Am I allowed to avail credit, or am I supposed to reverse credit common ITC? Then I would like to draw your attention under section 17, subsection 3.
Bimalji, I would like to interrupt. You can please conclude in the next few minutes. Other speaker is
2-3 minutes.
Sure.
I will not take more than 2-3 minutes.
Sure.
I do understand half an hour dedicated given to me. I will not go beyond that.
No, we would have loved to hear you for the rest of the evening, but there are other speakers as well.
Not an issue. Just 2-3 minutes more.
Thank you so much. Yeah, sure.
So what it is being stated under section 17, subsection 3, that for exempted supply for reversal of common ITC, Schedule 3 will not be considered except para 5, sale of land and building. So even the outward is not taxable, but still credit is available, advantage to you. So as Rajeev ji has already alarmed me that the other speakers are really waiting in, but for me it is an opportunity that they have invited me at this platform, and my special thanks to Tushar ji and Rajeev Khandelwal ji for this evening for discussion on supply. Within half an hour, whatever best I could have presented on terms supply with the practical case studies, I tried my best, whatever I can give it to you. And with this, I can wish once again happy CA Day, happy GST Day, and happy Doctors Day. Wish each one of you great success. Do take care of yourself. COVID-19, struggling and tough situation for all of us, but keeping positivity, passing positivity to each one of us. Share positivity and try to make best of this COVID-19 time period. Thanks for watching. Thank you very much.
Thank you so much, Bimalji, for the wonderful deliberations, and you made it in spite of your busy schedule today. So thank you so much, and you have really given a wonderful deliberation. Thank you.
Thank you.
The next speaker of the day, ladies and gentlemen, is Advocate Kapil Sharma, a partner at Lakshmikumaran and Sridharan attorneys. He is involved in transaction advisory practice of the firm. He has more than 12 years of experience in indirect tax advisory. He has advised clients on a wide range of indirect tax matters, including matters pertaining to goods and services tax in India. He specializes in structuring business operations, devising supply chains, identifying and advising on tax efficient business models, reviewing tax compliances, cross-border structuring, as well as structuring of business transfers, joint ventures, and foreign investments. He's also an active member of various trade associations. And at the advocacy level, he has been constantly helping various industries in the capacity building for the implementation of GST in the country. He's been an active speaker at various national and international seminars, workshops, and conferences organized on indirect taxation. I would request everybody to listen to Kapil Kumar Sharma ji, we welcome him.
Thank you, Rajeev ji, for the kind introduction. And I would like to take the opportunity of thanking the platform and the effort made by both Webtel and CGPI for collating so much of people for sharing of the knowledge, which is a wealth actually to be shared. And wishing on this very special day to all the professional colleagues of mine a very successful tenure ahead. And as Bimalji also pointed, we have to resolve that in this struggling time, we need to pass on the best that we can in terms of knowledge and enhance whatever possible aspects that we need to brush up in terms of knowledge. As a feedback, as a sincere feedback, my only suggestion was that while choosing topic, we could have done a touch better as far as allocating a multiple topic in span of 25 minutes. But then let us try and do justice with what we have. Maybe for next time, we'll be more cautious in terms of selecting the topic, because topics like anti-profiteering itself is a basic collation of so much of data, so much of controversy revolving around it. I think we need complete half an hour to 45 minutes to do justice to anti-profiteering. But without wasting much of time, let us go ahead and try and see what best we can consider in the following 25-30 minutes to take forward. Speaking about anti-profiteering per se, I think this term has one of the most debated terms ever since the GST has been introduced for past 3 years. The reason why this has been debated is this was introduced with.
Kapil sir, sorry to
Yes.
interrupt. Your voice is not audible. It is echoing. Could you please be little closer to your mic?
I am using headphones, should not be a problem. But just give me a moment. I'll just change the setting. Just give me a moment.
Yeah, because the voice is not very clear.
Are you able to hear me properly?
Yeah, it is better, I think now.
Sir, can you be closer to the mic of the?
Okay. I'll do that. I'll do that.
Now it is much better. Much better.
Okay, so I'll just raise the tone also so that I can be more audible. Coming back to topic again without wasting time. The anti-profiteering as a measure was introduced as an anti-inflammatory measure, keeping in the mind the inflation, which may be on the account of change in tax regime. Earlier, we were struggling with multiple taxes, such as GST, such as sales tax, service tax, excise, and so on and so forth, entry tax, luxury tax, entertainment tax. There was a plethora of taxes which were clubbed into GST when this was introduced. The intent of the government of introducing this section 171 was to ensure that the benefit on account of tax efficiency is passed on to the buyer. The events such as the conversion of taxes on account of CST, entry tax, and other were required to be merged. So if you see the definition of anti-profiteering, it actually triggers on two events. One is reduction in rate of tax, and other is benefit of input tax credit. When we talk of reduction in rate of tax, the point that immediately comes into mind is reduction in overall effective tax rate. When we say overall effective tax rate, we means excise plus VAT plus other tax which may be applicable in pre-GST compared with GST regime. And in case of a service tax and other taxes coupled with service tax and compared with GST. If the rate of tax of GST is lesser than the earlier taxes, then there is a reduction in rate of tax. The benefit on account of reduction in rate of tax has to be passed on by way of commensurate reduction in price of the goods to the buyer. Similarly, what also emerges is reduction in rate of tax in GST. As we have seen almost 36 months of GST, there has been shuffling of tax rate and goods amongst various slabs to the other slab. A primary example could be fast-moving consumer goods, which were earlier in 28% slab and they were bought down to 18% slab. Similarly, there were other goods which were again bought from 28 to 18 or 18 to 12%. Now this reduction in rate of tax actually reduce the burden of tax on the buyer as far as payout is concerned. What also it means is the prices of the goods and the reduction in tax rate shall not be pocketed by the supplier. It needs to be shared with the supplier, with the eventual buyer, and the same ratio shall be passed on. When we talk about benefit of input tax, the only thing contemplated under section 171 was to contemplate the earlier block credit, which are now available as a credit. The benefit of those block credit should be passed on to the end consumer and should not be pocketed by the supplier himself. I have taken two case studies to illustrate this entire scheme, and I wanted to emphasize on critical points, which are actually the struggling areas which are awaiting the clarity from the high courts. And eventually, I am sure that once the high court rules in any which favor, the other party is going to go to apex court to get a clarity with respect to anti-profiteering. Getting on with the first sector, I think this anti-profiteering has hit the two major sectors of the economy, one being real estate, the other being FMCG. These are the two case studies that I picked up so that we can broadly debate on this. If you see at the screen, the first and foremost submission I had was this anti-profiteering never gave a methodology by which a benefit could have been computed as to what is the quantum that should be passed. Neither there was guidelines, neither there was rule framed as to how you should compute, neither there were any clarification issued on this account as to how this benefit has to be computed. In the absence of these mechanism or guiding pillars, the SSE or the supplier were held or were actually clueless about the manner in which they should compute this benefit which is to be passed on. For the want of better benefit, everybody look at the appropriate method which they in their mind thought was the best and the closest to passing on the benefit. The major concern that was there in the mind of the supplier while computing was that they should pass on the entire tax burden which was available or which got unblocked in the GST regime to the buyer. And with respect to increase in input tax, the emphasis was the extra credit which was being available to the buyer on account of GST introduction was again to be passed back to the buyer. So in the absence of the method to be computed, they resorted to the best possible, which were again challenged by authority. Just to illustrate in the front of you, the slide deals with the method that has been followed by the real estate. In the inquiries done by DGAP, followed by NAPA, they have followed the approach of computing the credit vis-a-vis the turnover. While the pre-GST turnover was compared with the credit and the ratio was arrived. As you can see, it is 3.75. Again, in GST, the turnover was compared with the credit available and they came as a percentage. The difference in these two was considered to be a profiteering benefit going in the real estate sector. Why, according to me, this is not correct is for following reason. One, the turnover and credit are two unlinked because turnover depends upon demand schedule, which you have from buyers to pay the taxes, whereas your credit relates to cost of construction. Therefore, you can't have a turnover versus a tax rate approach because they are mismatched in terms of timing differences. Therefore, the benefit that is arrived is incorrect. The second major point was by this method, the credit of services which was always available to the supplier was again factored. In the service tax regime, if you go back, the applicable rate of services were approximately 14.5%, which got up to major amount of services to 18%. By this method, even when you compare the credit of services which was earlier available, the credit was increased by the 4%, which was a tax rate difference in the service tax vis-a-vis GST on the services component. For various reasons, this benefit or this method which has been adopted by DGAP and blessed by NAPA, which is pending before the high courts now, is not leading to an appropriate result because according to us, the right approach could have been to go to the cost and see what are the credit which are getting unblocked in GST. Perhaps that could have been a better method of dealing with this as compared to what has been adopted as a turnover method. Getting on to the second sector, FMCG, you may see very clearly that the method adopted by the SSE in this case was passing on a percentage of a benefit which is based on the tax incidence. So SSE was taking the applicable taxes at an average rate in the pre-GST regime, then comparing with the price, same he was doing in the GST regime. So he was computing the tax incidence based on percentage of price and passing on the benefit of the anti-profiteering to the buyer. If you may clearly see the screen, you may be able to find out that the MRP under the GST was higher. So was the discount, which is given in the B column, which was much higher. The authority was actually not accepting these kind of consideration because they have debated various items in this manner by which they have come up on the major observations. The major observation when you collate the FMCG sector as well as the real estate sector are as follows. According to me, there are critical 5 or 6 points. I'm trying to address each of them independently. According to me, the first point was the key observation made by the National Anti-Profiteering Authority, which is NAA, was to say that the benefit has to be computed at each SKU level. When you say SKU level, it means at each individual product which is offered by the company needs to be computed at that level. You can't club the benefit for the purpose of passing on the anti-profiteering benefit. For example, let us take and understand this by way of simple. So say Maggi is being offered in a single combo and there is a packet of Maggi which is at the 2 level. So two Maggis in a single pack and a single Maggi in a single pack. What eventually has been meant is you need to compute the price of each of these SKU and then pass on the price to the end buyer in the same proportion. Now, this may actually lead to little kind of absurdity in matters wherein the say Maggie was offered for 10 rupees and the profiteering benefit comes to say 20 paisa, which is not actually a legal tender, which is valid in terms of the RBI notification. How do you pass on the benefit of that 20 paisa? So these theoretical observations were actually given, observed, but effectively, if you see, the compliance thereof was actually literally impossible. In certain cases, even the authorities have gone beyond this and observed that if you are giving extra quantity in GST to pass on this benefit of anti-profiteering, say for example, Maggie was offered at 100 grams for 10 rupees, post GST, they could not have passed 20 paisa because it was a problem, a business decision as well as legally somewhere restrained decision which they were supposed to take. They increased the quantity from 100 grams to 105 grams per se. Probably this extra they have passed on as a by way of increased material, they have not considered to be a valid benefit passed on by the buyer. So these are the major observations, firstly, at the FMCG level, which are creating a problem. Second point, which I feel is the most important point, which is there in the Whirlpool decision that we have seen a while back, was the cost of raw materials, inputs that are independent of the which are independent of the computation of your price or the benefit that you have passed on. So they are considering that the cost of production with respect to manufacturing of a particular product will remain same in pre and post GST. Each one of you which are today listening to me will be very clear of the fact that the price under two tax regime can never be same. Price is a dynamic price which keeps on changing based on various decisions such as demand, supply, your market position, your season, and so on so forth factor. Probably the cost also undergoes a change as far as the time is concerned. Whereas the observation made by the National Anti-Profiteering Authority on this account is we would discount the change in prices. We would consider the prices as a constant in order to compute the benefit, which according to me is far away from reality. According to me, there is a major gap. Somewhere you are putting restrictions on the SSE in order to carry on his business freely, which is guaranteed by Article 19(1)(g) of the Indian Constitution. Moving further to another point, wherein I feel what they have observed is the benefit of anti-profiteering cannot be passed on by way of discount. Probably in major decision that we have seen, what they have observed is you need to mention very clearly that this is anti-profiteering discount or this is benefit on account of anti-profiteering under 171. To my mind, this is something you are having a post facto discussions on. At the time when the GST was introduced, there was no guideline as to what the discount should be nomenclature. An SAC who has validly computed the benefit and given the name of discount to pass on that benefit, you can't come back and say this is a business discount and I will not allow you as anti-profiteering. Perhaps the nomenclature of word discount has been misconstrued by all these decisions wherein they have said that business discount is used as a guise to pass on the anti-profiteering benefit, which I feel is not correct way of looking at it. You need to consider the normal discount policy and see if there is any additional discount. That additional discount has to be by way of some reason. And wherever the SSC has demonstrated that that extra discount which is being passed on is actually an anti-profiteering discount, that proof should have been submitted by the authority. Moving on to the fourth major point, according to me, is while they are appreciating the fact that you are free to carry on the business in India and free to determine your market price, but we will still consider the anti-profiteering benefit based on the base price only. Even if you have revised the product under business compulsion, for the purpose of computing the benefit, you will still take the same price, and this will override your power of revision of price, which is a business decision. This, according to me, constitutes directly constitution right, which is given under 19(1)(g) in respect of freedom to carry on trade and business. Another point, according to me, which actually is thought-provoking, is they have observed that sections 171 is not transitional in nature and rather permanent in nature. Enforceability of section 161 is perpetually till the time it is repealed. What they are trying to mean is we will not consider as any time limit to this section. Wherever there is any change in rate, wherever there is a change in a tax structure or input structure, anti-profiteering will immediately kick in at that point of time, and we will have to reconsider the benefit and the pricing calibration. One example could be similarly in real estate, the entire scheme of taxability got changed on 1/4/2019, wherein the new rates were revised with certain conditions. Each of these events, which is giving rise to rate change, are considered to be one of the major things that are having an anti-profiteering threat. Similarly, getting on to the other part of it that I want to cover and close, this section is subject to challenge, perhaps before the authorities, and the major challenges are: what is the validity? There is a structure problem in terms of the formulation of the National Anti-Profiteering Authority, the constitution thereof. They are acting as a price regulator and price controller, and they are not acting as a watchdog. They are taking ad hoc instructions, investigation period. They are ignoring the increase in absurd cost, which according to me is absolutely baseless as far as passing on the benefit. They are raising questions on the manner in which you are passing on discount. Then there are ordering that on the anti-profiteering amount, you again have to refund the GST also, which is collected from the customer. This again leads to double whammy to the all customer, that at the first place, they have paid the tax, and the supplier who are considered to be profited are supposed to refund the tax amount also to the buyer. This, according to me, is having multiple problems. This has to be taken up at the higher forum, and I am sure that the High Court will definitely do something with respect to how this ad hoc mechanism has to be stopped. Moving on to the second major topic that is given to me is composite or a mixed supply. When you talk about composite and a mixed supply, this is a similar concept which were earlier there in GST regime called bundled and other than naturally bundled. This is the same 66F which was there earlier. It was there in section 65A of the earlier regime, which was prevalent prior to 1/7/2012. So this has always been a case that a supply which is comprising of two or more supply, one of which is a major supply and the other is only adding value to the main supply or adding means to the main supply or enjoyment of main supply, it shall be treated as a principal supply. So I am taking ticket to fly to Bombay tomorrow. In the end course to Bombay, my flight will also be served with meals. These meals are nothing but these meals are ancillary to the transportation of passenger by air services. It is a perfect case of a composite supply wherein meals are actually ancillary to the main supply, which is transportation. I am taking the services of transportation, which is a principal supply, and the ancillary supply is a meal which is served on board. When we talk about mixed supply, when two or more supplies are actually aggregated without having their commonality, then those supply are commonly referred to as a mixed supply. I'll give you an example. We may go and do a packing for a gift hamper. We may pick up a chocolate, a box of a juice, so on and so forth. Now this is a mixed supply that we are going as per our own example and getting the box done. The box has a single price. Now that box consists of major products which are at different tax rate. The law is very clear on that point. It comes back and say the same thing, that we will not get into each of the product. Since you are charging a single price for an entire bucket and that bucket has major goods, we will pick up the good which is having the highest taxability on the particular bundle, and then the entire bundle will be taxed at the higher rate. This is what is concept of mixed supply. I have an example, which is a live example, which I thought I will raise if time permits. So just to give you a context, this is the common marketing scheme. You may hear these schemes which are applicable in various places. Oftenly, you will find real estate developer promoting the sale of flat by way of offering some kind of freebies. These freebies range from an air conditioner, home furnishing, or a car, or so on and so forth. According to me, the principal supply here is sale of flat. You are artificially bundling something which is a freebie. Now, in the law, there is nothing which is freebie. Freebie has always a price embedded in the principal supply. So when you are buying a flat of 2 crore, by which you are given a car, say of 20 lakh rupees, this 20 lakh is not actually free. The cost is embedded in the price that you pay for your product, which is the flat in this case. The question is, what will be the applicable rate? Now go back to the definition of the main supply that we were discussing, whether it will be mixed supply or not. Yes, they are not naturally bundled, they are combined together. In this case, since it is charging a single product, say 2 crore for a flat, that is a single price which is charged for both flat as well as car. car attracts 28% plus the other cess, whereas the GST on the flat is 12 or 5% as the case may be. What the law will tomorrow come back and say that I will tax the entire flat at 28% plus compensation cess and not at 5% or 12% applicable to the flat rate. Therefore, the problem of composite and mixed supply needs to be looked whenever you are bundling two supplies. Just be sure on this point. Otherwise, you may have to bear a drastic consequence with respect to them. I have done two case studies. I will briefly conclude these two case studies. The first one relating to sale of developed plot. You are finding a lot of controversy with respect to what is a tax rate applicable on sale of plots. When we talk of sale of plot, generally you are not going and buying an agricultural land. What you look at is a sale of a developed plot. When you say developed plot, why it is developed? The difference between agricultural land and a developed land is it undergoes a transformation wherein the amenities are added to an agricultural land. The process goes like this. The land is first converted from agriculture to the plotted land. On the plotted land, you bring up the various amenities such as common road, sewage, transportation, pipeline. Then you bring up telephone line, you bring up clubs, you bring up common infrastructure for the particular plot of land. When you add all these things as an amenity, it becomes plot. When you go and sell the plot, it is not a case that you are selling plots independent of these facilities, or buyer is not looking at these facilities independent of sale of land. Therefore, these are actually naturally bundled when you go and buy the price of plot. Though there may be a separate charges which you are charging for amenities, but essentially amenities has no standalone existence of their own. I would give you a different example to understand this is, even if you are sold 20% of your flat available in the entire township, yet you have to develop 100% of the common facilities. Therefore, we mean to say that amenities are integral part of the plot of land. They are not dependent upon whether you are selling a land after completion, post completion. They are integrally connected. They are part and parcel of basic sale price that you are developing. According to me, the approach taken by all the advanced ruling on this point is absolutely contrary to the understanding that is there prevalent in the industry and in the books also. Fortunately or unfortunately, you may also refer to the decision that they are citing in support of this. In one of the advanced ruling I was going through in the case of Gujarat, they are citing the case of Narne construction, which is a law on the consumer forum. When a consumer forum is being interpreted, the interpretation given to consumer is much wider. The interpretation given to the term service is much wider. They are borrowing the decision of a consumer forum wherein service has been widely defined to give meaning to the common facilities as a part of services. According to me, in case of sale of plot of land, there is no construction done. There is no separate provision of common facilities. They are integrally connected. To me, these advanced ruling are not laying down the correct law, and they are not appreciating the provision and has to be taken up. I'm amazed to see that not many of these people have gone to High Court to challenge it and see how they come along. Moving on to the second example that is given to me is with respect to supply of electricity. I will just not refer to the slide and make it very simple to understand. We may refer to the supply of electricity which are given to us at a home level. When we go on to the authority to apply for electricity connection, they will charge us for certain thing as a fixed fee. These fixed fees are connection charges, meter charges, then they will lay down the wiring charges. So they collect certain charges to give a new connection. And then at every month, you will be charged variable amount based on your consumption. Plus, there are certain specific services which you may ask on a need basis. Suppose you are doubtful that my meter is running fast, I want to get my meter tested. So there is a facility called meter testing charges, which you may opt. If you refer to the provisions of Electricity Act, they are governed. The entire Electricity Act governs the manner in which this charges has to be charged. Section 45 of the Electricity Act is absolutely clear and gives power to the State Electricity Regulating Commission. In Delhi, it is DERC, Delhi Electricity Regulation Commission. They are the premier body which is supposed to conduct the charges, which are supposed to lay down the charges, which are supposed to be charged from buyer. Now, I'll take an example and then we got on to the amount which is paid by me as initial connection charges for meter, for wiring. Are they composite supply or are they different supplies, or are they independent supplies? This is the primarily question. According to me, the act of taking meter, or act of applying for a meter, or act of applying for a commission is your first step towards getting the electricity. You are getting this, or you are paying this integrally to get the electricity. This does not have a standalone existence of it. Why would you go on to apply for a electricity meter if you don't intend to consume the electricity? To me, the fact that these charges are fixed charges does not make much of a difference. The charges can always be fixed plus variable. Consideration can always be fixed plus variable. What you need to understand is whether these charges has a standalone existence or not from a customer perspective. According to me, I still find the same answer. According to me, these charges which are charged as a fixed charges towards say meter replacement, meter connection, special deposits, or their deposit work which are undertaken by these electricity distribution companies, all these things are nothing but they are integral part of supply of electricity, and they have to be read along with electricity. You cannot charge tax on this quantum. You cannot consider them to be independent service given to buyer. This is my view. This my view is also endorsed by Gujarat High Court in the case of torrent power. Exactly on same line they have held on each of this principle that I've explained you, that they don't have an independent existence. They have considered the part from a perspective of how buyers looks at it, how industry looks at it, what is the industrial framework, what is the legal framework. By considering each of these arguments, High Court has categorically run down the circulars and the instruction issued by service tax or by the GST authority, which is proposing to levy GST on this independent supply item. They have held that these are integral part of supply of electricity, therefore you cannot charge tax on this. But this controversy is looming large because there are multiple advanced rulings which are against this point. Despite of Torrent Pharma, which is a high court holding this, still they are being charged. The only difference here is Torrent Pharma is pending before Supreme Court. They have only issued notice. They have not stayed the proceeding. Why the authorities are not taking the decision passed by Delhi High Court in consideration while passing this AAR, I am not sure. Unless the decision is stayed by the Apex Court of India, it still holds goods. The decision and the ratio of High Court still hold goods. The AAR are much lower authority in the pedestal or in the food chain of litigation strategy. They cannot override this according to me, but yet you are finding this. What I suggest to all my listeners is wherever you have opportunity to understand these things, kindly instigate client to go on to a next level wherein you have scope of making the law which is a fair to public, because eventually the money will go out from your pocket. Moving on to the last aspect, which is the return part of it. When you talk about return, the first thing that comes to my mind is with respect to what has happened to Delhi High Court in the case of Airtel, right? The Delhi High Court in the case of Airtel has held categorically that the 3B is a return which can be amended. Now, after this decision, unfortunately, if you see two sides, first, the utility for revising the 3B return is not enabled on the platform. What you see on a platform is only amendment for the new returns. For the 3B, there is no per se utility available on the portal to make an amendment. How this will be affected, it has been a decision. This decision has been rendered almost 3 months now, but no step has been taken in order to provide this facility. Second thing that comes to my mind is with respect to how should you be able to treat these taxes of which have been paid by the SSC, say in the Airtel case, July and October, July, August and September taxes which are excess paid by Bharti Airtel for a period when they had the input tax credit, how they will be applied as a refund under section 54. Will government consider timeline of 2 years, or will they consider that this refund arises out of the order passed by the court? Therefore, the 2 years will apply from state. So for refund also, you see a challenge in authority going back and giving you refund. One major thing which I was wondering with respect to this decision is in the context of the claim which is made by department on account of mismatch. So they are asking you to reconcile your 2A return with your input register. Wherever they are matching, wherever the 3B is not matching with 2A, what they are saying, we will not deny you credit as these taxes has not been paid. According to me, these kind of cases run down to the scheme and they help you to defend the position stating that 3B is not actually the return, 2A is not the mechanism which was prescribed in initial law. As and when this law was introduced, the scheme was having GSTR 1, 2 and 3. The 2 and 3 was never introduced. Therefore, this mechanism of matching 2A with 3B is something which is created by department on their own, and it cannot hold ground as and when contested before the department. Definitely, this ratio of Airtel will help you to defend those claims wherein department is reversing the credit or proposing to reverse the credit based on the mismatch on the account of this. Another important thing I thought I will touch upon was with respect to section 16.2. If you refer to this condition for availing the credit at the hands of recipient, you will find one condition wherein they saying if the tax has actually been paid to the government, only upon fulfillment of this condition we would allow you the credit. To me, if you read 16.2, all the conditions which are there are from the perspective of recipient of services. These services are not from the recipient or providers end. This is the only condition which is available from the providers end to see that the taxes has been paid. If you read down the law, as you may be aware, there is no mechanism which is available with the recipient of services to ensure that the taxes thereof has been paid by the recipient. Only thing that you can check is whether the taxes which have been paid are reported in 2A or not. You may be very well aware that 2A gets auto-populated from GSTR 1. GSTR 1 is not authenticated proof of whether the payment of tax has been made, because tax payment can only be made in 3B and not in 1A. In the absence of any mechanism at the end of the recipient to ensure that the taxes are paid, keeping in mind, according to me, this condition is far-fetched. And you may also like to refer to the decision which has been recently passed by the Honorable Madras High Court and the other High Courts on the similar point, wherein the similar condition was read down in the context of the earlier VAT regime, wherein this condition was, similar condition was there. Perhaps you have a very well lead which you can take from those decisions, which you can definitely use. I will touch only one more topic and then I will conclude because I understand there is a paucity of time. Another interesting thing that
Kapilji would request you to conclude in the next few minutes because
I'll conclude in last topic, 2 minutes, only 2 minutes.
Okay.
I'm only touching on a very interesting aspect.
Sure.
Many of us are aware about the MSME Act and the condition disposed by the MSME Act, wherein the payment to the MSME supplier has been mandated to be made within the period of 45 days. Now, I'm just evaluating the similar kind of condition wherein you are supposed to pay taxes along with the base price to the MSME Act within 45 days, but you don't have a wherewithal to ensure that the MSME supplier has paid tax to the government. The problem is even more worse in the case wherein the supplier pays tax on a quarterly basis. Because if you have to read down this condition under 16.2, then you have to give it a natural meaning. The only point I'm trying to emphasize is the condition of tax paid has to be seen qua the provider. It cannot be, my bad, it has to be seen by the qua the recipient. Had recipient paid the taxes to the provider and for some reason provider is not able to file return or pay tax, you can't go back and penalize the recipient who has honestly and honestly paid tax to the provider who has failed to pay. These kinds of conditions are retrograde. They are actually putting the people under a scanner for no act and no fault of their own. With this, I would like to have a conclusion from my topic. I will be happy to take on the question which are there in the answer. I again sincerely thank all the organizers for putting across a wonderful show and having so many people. Thank you so much, sir.
Thank you, Kapilji. It was a wonderful deliberation, and I think many of the doubts of the people were cleared by your lucid presentation. Now, I would request the next speaker. Let me introduce him first. We have with us Ishaan Patkar, and he's a CA by profession, but he's practicing as an advocate at High Court and other courts. He specializes in commercial, civil, and taxation law for various fora. He's authored various books. He's authored various books like GST Law Guide and another book, Concept of Supply, etc. And he's also been a member of Indirect Tax Committee of the Institute of Chartered Accountants of India and other fora like Bombay Chartered Accounting Society. He's addressed numerous seminars on GST organized by ICI and Goods and Services Tax Practitioners Association of Maharashtra and other associations. He's a regular contributor on GST and VAT in Sales Tax Review, AIFTP Journal, etc., and is actively involved in social service projects aimed at improving education standards of public schools in Mumbai. With this introduction, I would request the speaker to begin his deliberations. Come, sir.
Hello.
Yeah, please start your deliberation.
Hello. Can you? Yeah, Pitam, can you just put on that note on the screen?
It has already been there. You can start the deliberation, Ishaan.
Okay, I don't know why it's not showing on. Okay. Okay, so good evening, everyone. I'll try to be brief because I think otherwise we'll vastly overshot the time today. Now, my topic today, I think, judgments under GST, the landmark jurisprudence. I have compiled some of the judgments, the important ones, especially transitional credit has been given to transitional credit. There are so many judgments that I've just taken 3-4 main judgments to discuss. The first judgment I think that we should start before going on the Tran 1 credit judgments is the judgment of JCB India of Bombay High Court. Now, in this case, the issue before the court was we have this 1-year limitation in section 140, subsection 3, subclause 4, that invoice has to be dated 12 months. Invoice for the stock has to be within 12 months of July 2017. Now, before the High Court, this provision was challenged in JCB India, and various grounds were taken. Some of the grounds were that this is a vested right.
Ishaan, excuse me. Can you please be a little more clear or be near to the mic? Your voice is not very clear.
Let me just change the mic 1 minute.
Yeah, yeah.
Hello?
Yeah, it is better, I think.
Now?
Yeah, it is better.
My bad. Okay. So various grounds were taken in this case that Senvat is a vested right, that one of the arguments was that this repeals and savings clause will save all the earlier rights, etc. The Bombay High Court, however, gave a judgment against the taxpayer. I will only very briefly explain in simple words what the Bombay High Court says, and which in fact I agree with, at least with this case I agree, is that this theory of vested rights which has come from Eicher Motors, etc., that Eicher Motors was a case where the credit was taken away by the government by way of rules and not by way of the parliamentary enactment. In fact, if you see later that Osram, etc., that after the amendment came in the Parent Act, in the Excise Act, in Osram they held that they have the power to take away the credit also. However, in GST, what has happened was it is Parliament itself which took away the vested right or accrued right, and the Bombay High Court said that unlike the rule making authority, Parliament has wide discretion. If they want to take away vested rights, they can, or they want to take away accrued rights, they can do it. The grounds of challenge under Article 14 are very limited in such case. So that theory of vested and accrued right was, in fact, one more observation is very important. What the Bombay High Court has said is that this may be a vested and accrued right under the old law, but with the repeal of the old law, everything gets washed away. Under the new law, if there is a benefit that they want to recognize, then you have to fulfill the conditions. Unless the conditions are fulfilled, you cannot be said to have a vested right under the new law. Your old law vested does not mean anything unless the new law recognizes it. That brought the court to the next argument of the repeals and savings, that section 174, which says all obligations are saved, all rights are saved. The court dealt with it in the following manner, that even if it is vested or accrued or whatever, if there is a special provision in transitional provision in section 140, then a general provision like a repeal provision cannot be used to give what 140 has specifically taken away. So that is in short what JCB India said. I am largely in agreement with this judgment because parliament enactment cannot be struck down on the theory of vested rights that has been done in Jayam. I think that Jayam case in the last paragraph on the theory of vested rights, Justice Sikri did say that Article 14 challenge can lie where people have already taken the credit, then retrospective amendment may fail in case of those who have a vested right. But that was a case where the act was not wholesale repealed and replaced by a completely new system. So that Jayam is a bit distinguishable. Then we come to the Gujarat High Court judgment in Philco. What did Philco say? Philco in fact gave a completely opposite judgment than the JCB judgment. Philco said that the 1 year limitation in 140 subclause 3, subsection 3, subclause 4 is ultra vast on the theory of vested rights itself. And then they wedded that vested rights with Article 14, etc. As I said, I am more in agreement with the Bombay High Court judgment, but of course, those who want to argue can argue. We also argue and we have to we rely on Philco. JCB India Bombay High Court judgment was specifically disagreed with. I am told that Philco India has, in fact, Philco has been stayed by the Supreme Court. I'm not sure whether JCB people have gone to Supreme Court or not. Last time I had asked them, they told me they're not gone. But let us see. At least Philco is in Supreme Court and it's been stayed and notice is issued. Then we come to the evergreen topic of transitional credit TRAN1 form. Now the TRAN1 form you had to file firstly within 90 days and extension of 90 days. Everyone knows about that form itself. At what time it came, God knows. At least I think till September or October the form was not there only. It is very I personally, because I have been appearing in a lot of matters of transitional credit in the Bombay High Court. I think at least 30-40 matters so only I am appearing, and there are many other matters, many other advocates appearing. Every time the revenue gets up and it says we had given so much time, you have to be diligent, etc., etc., etc. It is quite surprising that if you cannot bring your system on time, no form of yours has ever come on time, no utility has ever worked, no deadline. Government is not doing a favor to the people by extending deadlines. Their utilities don't work. It has become a universal truth now. That being said, then when you tell the people, अरे हमको संभाल लो, क्योंकि first time है हमारा इतना बड़ा system है, we are also government also needs time. I expect the government also to then, extend the same understanding attitude to the people. It's a disgrace. It's a complete disgrace that these matters are traveling to the Supreme Court for the mere filing of a form. And it is high time that the Supreme Court also reminds them that this is not something that they are supposed to hold on to. And coming back to the law on this, there are very strong grounds that this time limit is only procedural. Delhi High Court in brand equity has taken the correct view that this is procedural for the very simple reason that there is no this one mentioned in the rule itself. They don't say what happens if the form is not filed, if there is no consequence mentioned to it. I think it Justice Vipin Sanghi's judgment very eloquently says that ultimately if the law does not say that what is the consequence of non-filing, then how do you take away the credit? When Parliament has said that you are entitled to credit, then there must be some provision further saying that then you become disentitled if you don't file the form. That is basically brand equity said that. Then I think the Punjab High Court has also taken that view. In Gujarat, there was earlier Willowwood was there where they upheld the validity of the rule. Now, while upholding, I'm very sorry to say that judgment of the with utmost respect to the those who decided it, they happen to be in fact one of the leading jurists in India. However, the problem that is crept into Willowwood is this: they used the judgments like Mafatla, etc., where the act itself had put a limitation. In this case, the argument was that the rules cannot put a limitation when the act does not. That is flowing from that Bharat Barrel, K.I. Abraham, etc., etc. K.I. Abraham completely covers the issue. There is no need to go to even Bharat Barrel. However, the Gujarat High Court, instead of discussing K.I. Abraham, discussed everything under the sun, and all cases in which the limitation was placed in the parent act itself, not in the rules. There is only, I think, one Godrej judgment which has been discussed, Godrej Boys judgment, where the limitation was put in the rules, but the credit itself was a creature of the rules. In Godrej, the Maharashtra or Bombay tax input tax credit matter which had gone to Supreme Court, the rules themselves had created the right to credit, and then the rules took it away that by limitation. That was upheld by the court, but not this. K. Abraham directly applies the rule has to be ultra wires. However, as I said in Willowwood, they said they relied on all the wrong judgments, and then they said that the tax administration will collapse if
Ishaan, are you there? I think he's not audible.
I think he got disconnected. I'm checking on that.
In the meantime, can we take up the question answers?
Yes. Abhishek, could you please start the question and answers?
Yes, sir. So first of all, I would like to, wish everyone happy CA Day and happy GST Day. And so also I would like to thank all the eminent speakers for such an insightful session. The knowledge that we have gained today would definitely help us in facing the day-to-day professional issues. So without wasting any time, as I can see a lot of participants are intrigued about issues pertaining to the judgments, I will straight away go ahead with the Q&A. Since the subtopics were divided amongst the speakers, question will also be taken subtopic wise. So my first question, I think Ishaan is there.
Yeah, Ishanji is back.
So let him continue, Abhishek.
Yeah,
that Q&A, I'm very sorry. There is some great problem in my internet. Even in the High Court hearings, this net keeps on giving me trouble. Now, see, I just have another 5-10 minutes. We don't have lots of judgments on these issues, assessment, etc.
Okay,
So
you can
Willowwood,
conclude first. Yeah, you can go ahead.
In 5-10 minutes,
Sure.
in Willowwood, one of the things which was said was people will take after 15 years and 20 years. That is completely wrong. Brand equity.
I think he's once again got disconnected.
Let's continue with the question answers then.
Okay. So my first question was on ITC, and so.
I'm so sorry.
It's getting a comedy of errors.
I don't know what problem is happening. You start the Q&A. What to do now?
Yeah, okay, we'll start the question and answer. Right.
Okay, so coming back to ITC.
My slide is, if you have time at the end, I will deal with it. Otherwise, participants' time will be wasted because of my net.
Okay, right, sir. So my first question is on ITC. Whether ITC needs to be reversed on the impairment of assets. Tushar sir, can you throw some light on this?
So the reversal with respect to impairment of ITC depends upon the underlying cause for impairment. See, if it is only for accounting purpose, then no reversal is required. However, in case the goods have been lost or destroyed, reversal is required. To substantiate this, if we see section 17.5H, it talks about reversal of ITC on goods which are lost, destroyed, or disposed of by way of gifts, etc. In this case, whatever the words which are used, like lost, destroyed, these are the situation wherein the goods are no more in your possession. they are lost, they are destroyed, they are no more in your possession. So the word written off there in section 17.5H has to be read in consonance with the words lost and in company of the words like destroyed, etc. And only in case you are impairing the goods or writing of the goods because of the reason that goods cannot be used anymore and they are destroyed, then only reversal is required. It is only for, if it is only for accounting purposes and the inputs and input services and the goods are still with you, then no reversal required.
Okay, right, sir. Uh, nice deliberation, sir. My next question is on anti-profiteering. What shall be the fate of inquiry under Section 171 and adverse order passed by National Anti-Profiteering Authority? In the absence of proper methodology prescribed, how fair the report and how far the report and order passed will hold water? Kapil, sir, can you throw some light?
Yes, Abhishek. Abhishek, I think the question is only on the point that how far this process of anti-proctoring will go on. According to me, the answer lies in the fact that I explained a while back, wherein I mentioned that in the absence of any clear guidelines laid with respect to computing this amount of benefit, I think the SSC has a fair chance to go back. Wherever the SSC has passed on the benefit, I feel if you can justify the means by which you have computed, you should be able to succeed before the High Court or by the forum. On a point that how far will this authority and the constitution thereof will hold good, as discussed in the course of the presentation, I think there are several points which you need to consider. One, the architect. The other is the presence of member. You would also like to consider the decision of the Bombay High Court in the case of Hard Rock Castle, wherein the order was signed by only 3 authorities, wherever it was required to be signed by the four person, which are the 4 members. There are various points with respect to the flaws in constitution of this authority and the way they are carrying on this purpose. According to me, these orders are very reluctant and they have to be taken up by the authority. The chances of dealing this as unconstitutional are little less, but yes, these orders which are actually vague and without any basis will not be held or upheld by High Court with respect to passing on the benefit. SSC has a fair chance of succeeding in the cases wherever the benefit has been passed on. To me, it looks very, very slim chance of department succeeding before this ultimate court of India, which is the apex court, against this manner in which they have bought in and carried out this authority. To me, there is a fair chance to succeed before them.
Okay, right, sir. So next question is on promissory estoppel. Suppose the courts have passed in principle favorable order. However, such orders are not implementable principally, practically. Should they be proceeded with? Sudipta, sir?
I'm not very clear on the facts of the question, but see, at times there are 2 aspects to it. One is that, while filing a petition, one has to be very clear as to the prayer. So in the prayer itself, I think a party needs to outline what is the relief they're seeking, so that the court has that much benefit, has the practical insight in molding the relief according to the party. If we have not done that at the prayer stage or during the argument stage, and the judgment comes in which is effectively unimplementable, frankly, there is not much of a option or solution left. I think you have to do it at the planning stage and not at the later stage. I guess after that, the only way would be to probably seek a review of the judgment or a rectification of mistake, depending on what is the nature of the impossibility. That would be the only option. I think the prudent thing would be to take care while drafting the petition.
Right, sir. And there was one more question as well. Whether VVF judgment can be applied to the case that export turnover has been restricted for refund.
I assume we are talking about the
1.5 restriction, sir.
Yeah, 1.5 times. See, if we look at VVF and for that matter, the whole jurisprudence on promissory estoppel, they clearly say that there is no promissory estoppel against the legislature in that sense, or the law in that sense. While the rule 89.4 is technically not a legislation, it's a delegated legislation. But I don't think it can be said to be, there was no promise. It came as a part of a law for giving refund for exports. So I don't think promissory estoppel is a reason to challenge or is a ground to challenge 89.4. But of course, there are very strong arguments against that amendment because it is ultra virus, the section whether 16 or 54. And to that extent, I foresee that it will not survive a challenge in a writ. Promissory estoppel is not a right argument to challenge 89.4.
Okay, right, sir. Thank you so much. Uh, the next question is on transitional provision. Since the time limit has expired under the Limitation Act as well, and Supreme Court has stayed the judgment passed in brand equities, now what shall be the remedy available?
No, see, I have been dealing with the same question. What has happened was many people have just done nothing. What they are doing is they are waiting for someone else to get a judgment. Forget Limitation Act, even otherwise on delay and lashes, your 3 years is more than this one. Now, if the Supreme Court allows brand equity and issues an order just like brand equity, what had happened that the Delhi High Court issued a general order allowing everyone to take the credit. In fact, that is why government got a stay. Otherwise, they would never have got a stay. Now, if the Supreme Court gives a positive direction like that, well and fine. But if brand equity's case succeeds only on law, general law, and then someone else tries to get it, I think he will have a problem with delay and lashes. Like this, high courts will not entertain it. Those whose cases are pending, their cases will anyways be, because they are sub judice, they will get the benefit. What can be argued, however, was since the limitation itself has been suspended by the Supreme Court and because of this coronavirus, 3 years actually have not expired. Even under Limitation Act, 3 years have not expired. People are not in a position to go to court since the last 3 months. So after they are like this lockdown is substantially open, I would advise them to at least file a petition in their respective high court and keep it. Otherwise, at least file your claim. That you have not filed a claim within 30th June is okay, but within 15 days or 20 days when you are able to, by end of July, at least file your claim before the authorities so that whenever the order comes, it will automatically apply to your case. Don't wait for brand equity to be decided after 2 years or 3 years.
Okay, okay, thank you, sir. So since we are short on time and so only a limited queries could be taken up, I assure each of the participant that queries shall be answered personally offline. So, sir, shall I continue with vote of thanks or will Ishaan sir continue with his PPT?
Whatever you want. You want me to continue? I'll finish in 5 minutes.
Yes, sir. I
Let's
think.
give 5 minutes to Ishaan. Ishaan, you can
Yes,
take
yes.
5 minutes and thereafter we can have a vote of thanks.
Okay, just put that note, no?
Yeah.
And let us hope there is no mishap now.
Tom, could you please help us?
Okay, I'll.
See this.
Okay.
Yeah.
So now below would I have discussed brand equity. I have discussed, and now one of the issues which is going around is this issue of interest. If you see interest, if you have self-assessed interest, then they directly issue a demand notice under 79, 7512, read with section 79. They are directly issuing recovery proceedings. The first question is there are three judgments of three different high courts saying 73 74 procedure has to be followed. Now if you see that LC infra judgment, my personal view is that 73 74 people are taking a shortcut by arguing 73 74 for interest. It will come back to bite them someday. That is because if you see 73 74, that does not deal with interest at all, pure interest. It is tax plus interest. Now the only way you can put interest in 73 for 74 is to say is that tax is all, interest is included in the word tax. What has happened, I'll tell you practically. In Rajasthan High Court, I'm appearing in a matter where the officer is relying on all this LC infra etc and saying because now they have said 73 74 में interest बैठता है तो मैं interest के ऊपर penalty लगाता हूँ, interest के ऊपर interest लगाता हूँ. These are some of the consequences which follow. 73 74 need not be relied upon. You rely on the judgment of Arcot Textiles of Supreme Court. In labor law, there is a provision for payment of some charges if and natural justice is provided. Then there was a separate provision for interest. In that interest provision, it was like our 75-12, they did not provide for natural justice. So, and our revenue argued there is no natural justice because it is automatic. Deepak Mishra struck down that this was all those notices saying that natural justice is still required even though it is not written in the interest section. There is nothing called an automatic liability even in interest. So that is my view on this LC Infra and those two judgments which have come from various courts. 73-74 is a bit problematic. Then in refunds as of now many petitions are pending. I don't think any great decision has come in refund except these two judgments of Amit Cotton and Precourt Meridian. Now what is happening is if you see section 54(3), they have the power that there is a condition if there is a CGST drawback or if you have taken refund of IGST, you won't get the zero rated ka unutilized credit ka or this one refund. These people have brought a new circular saying that under customs drawback, if you avail higher rate, then you will not get refund under IGST. That the Gujarat High Court in Amit Cotton and Precourt Meridian Madras High Court have as good as said that it is ultra vires for the simple reason that the government has no power to put new conditions on refund which are not appearing in section 54 itself. If you read 54, you will realize there is no power given anywhere to the government to put conditions or to bring on the quantum of refund itself. And if you read even section 16, it says that the power to put conditions is on the physical act of export, not on the quantum of refund. So then my matter is pending even in Bombay High Court. But anyways, these two judgments are there of Supreme Court. Now the only judgment which is remaining is that Nelco in transitional credit. Nelco has followed Willowwood. They have distinguished, they have of course not understood the difference between the Mafatlal line of judgment where the limitation is in the act and what K.I. Abraham etc. said where the limitation was in the limitation was brought through the rules and Supreme Court struck down. In central sales tax, earlier in 1950s, there was no limitation for submission of C form. A rule was brought saying you have to submit within 3 months. Justice Ramaswamy struck it down saying that you have no power to bring limitation through rules because it is a substantive law which cannot be brought through rules. All of this was cited. However, one of the new reasons, largely we have followed Willowwood, one of the new reasons which the Bombay High Court has given is that since it is transitional, it is implied that it cannot be for unlimited period of time. Now that, of course, I think Nelco is not in a position to go to Supreme Court on that particular point because as of today, a retrospective amendment has anyways come, allowing the Parent Act to put, allowing the government to put limitation in the rules. So that is gone. But I must warn everyone, those who are situated in the state of Maharashtra especially, that Nelco does not deal with the procedural mandatory issue which brand equity Adford and this Gujarat High Court did. That is because I was there in Nelco also. Our petitions were delinked. We were all arguing on procedural and mandatory because ultra wires, why do you want to argue when you have procedural? You can say it is procedural. What the Supreme Court, what the High Court did was because the main counsel, that is the lead counsel in Nelco, said that I don't want to argue procedural mandatory. The court has in fact passed an order saying that we will only decide ultra wires. Procedural and mandatory issues they detagged and they kept separately. There is a specific order which is not mentioned in the last judgment. There is an order which is passed separately. Now all the other issues like this one, procedural, mandatory, etc., are still pending in the Bombay High Court. They were listed, in fact, for final hearing in the month of March, but unfortunately, because of this corona, we don't know when it will get heard. So it's not a reason to lose hope. There are many petitions still pending in Bombay High Court on whether 117 is procedural or not. I think I have covered everything. Abhishek, you can take over.
Okay. Thank you, sir. So earlier there was a lot of comprehension regarding future of GST about it being a simple law, etc. With time, it can be seen that majority of the law is different from what we have seen earlier, and a lot of open-ended issues exist in the law. As Bimal sir said, a person can do practice in GST for over 100 years. Also, due to the number of compliances, most of us could not keep pace with the ongoing judgments. Therefore, on behalf of CGPI, North Zone, and Webtel, I would like to thank all the respected speakers for letting us know all the landmark jurisprudence issued under GST, along with their opinion regarding the sustainability of said judgment. This would really help us in taking decisions as far as different aspects of GST is concerned. It was such an enriching session that even after 2.5 hours, I can see in the chat box that participants are still active. I would again like to thank all the speakers for sharing their knowledge. Thank you so much, sir. I would also like to thank Webtel as well as CGPI, the moderators Pitam Goel ji and Rajeev Khandelwal ji, and the office bearers for choosing such an interesting topic for the webinar on the occasion of 3rd anniversary of GST and organizing it wonderfully. Last but not the least, I would like to thank all the participants for being such a nice audience and adhering to the meeting rules. Also, I would like to urge the participants to, enroll for the membership of CGPI for more such sessions. Thank you all. Stay safe. I guess we can end the meeting now.
Just want
Thank
to,
you, Abhishek.
just in case you have any doubts which is left, you can mail us to the given mail ID. You can take a screenshot, that is contact us @webtel.co.in, and we can surely revert back to you on behalf of the speakers. You can also contact us Webtel for all your compliances needs at the given numbers. So before we conclude, I would like to request all the participants who are present in a big number even now, so kindly take a screenshot of the same. Thank you, Abhishek, for such a good.
Thank you. My pleasure, sir.